Hello everyone, this is BHAVIK CHOKSHI here and I hope you guys are doing great. Today's video is a very important video where we are going to discuss about the new theory which is added in your CA Final AFM material along with the practical questions for the new topics added even in business valuation. So you have valuation of startups, distressed companies, ESG based valuation, etc., for which the institute study material has given theory, but there are no practical illustrations. We have devised around 11 small, very easy and understandable illustrations for you to go through. This will help you understand the theory flawlessly as well as ensure that if a descriptive question comes or if it comes in a smaller MCQ, you would be able to at least easily apply. So ensure that you refer this. So this is the section on the new theory which is added, which we have shared already on the Telegram. You would be having it. And you will have this on business valuation where we are discussing around 6 or 7 pages. We will be discussing the important areas, methods and a small illustration on them. Not more than spending 5 to 10 minutes for the understanding of the method as well as the practical application so that it gets done in a much more exhaustive and an exam oriented manner. Okay, so let us get started. So among the various points which are added in the new theory of your study material, and I would say that these are important because if you open the May 24 RTPs or the May 24 2 mock test papers, majority of those questions have come from the new theory added. Something like a unicorn, something like succession planning, etc. have all been from the new theory section. So ensure that you spend some time and get this done. There's a probability that at least one question from this section will land up in your main exam over and above what the existing theory was. Okay, so that kind of takes care of the basic introduction. Over here, the important areas of the new theory added, if I were to identify, would be in your derivatives. Surely you have some exotic options, credit default swaps, weather and energy electricity derivatives that we have discussed in derivatives, but nevertheless we'll kind of quickly discuss this again. Then you have business valuation. I would say this is a very important thing. Within startup finance, the concept of unicorn as well as succession planning, which I would say both of these are important. And within international financial management, you have the concept of international financial center, something like a gift city, which is important. And in securitization, you have tokenization and blockchain. So basically over here, among the new topics added, I would say within securitization, you will have blockchain, which is also now added in FR, along with tokenization concept, which is important from an exam perspective. Within derivatives, the new products added, the exotic derivatives, credit default swaps in particular, CDS, and weather derivatives, etc. are important. In international financial management, what is an international financial center, and more notably probably a note on gift city is also possible. And in business valuation, the new valuation of a startup, of a distressed company, of ESG. I would say ESG is something which is very buzzing in today's environment, and there is a possibility of a question being asked on that. Within startup finance, the concept of unicorn and the concept of succession planning is what is more important. Apart from that, we will cover everything else which is in the other chapters as well. Like in your mutual funds, there is a term like a Sortino ratio or something which they have also added. A few other theory parts, but we'll first focus on the important parts. I'll first start with business valuation, which is the most important, I would say, from this, and then move on to the other area. So this is a broad introduction of what is the background over here. So let us start with business valuation. So when you go to the theory for this, I think over here around on page number 40, what I've also tried to do is I've tried to highlight a few things over here already, so that probably you can just focus on the keywords. Not that you have to remember and reproduce those keywords, but just that there is so much of theory, it makes it a little more easier for you to kind of connect with those keywords. So over here you will have business valuation. First, there are 6 areas over here which are to be discussed. First, there is something called as going concern versus non-going concern value. The working over here is quite easy. In terms of a going concern value, you will get valuation using various methods like your asset method, like your NAV, income method, or any other method. But when you look at the going concern valuation, you will also attribute certain value to the reputation, brand name, goodwill, etc. of the company, because if someone were to acquire your company as a going concern, they will pay for the reputation as well, and hence a going concern value will usually be slightly higher because it is a continuing business and it is more than the sum of the individual parts of that business. And as a result, usually as compared to what your existing base value would be, like a liquidation value, a non-going concern value will be a liquidation value. That is, if I were to liquidate the company today itself, then how much value will I get? Usually that is based on the net assets that will be realized if I were to sell it today. However, if I were to sell it as a going concern to someone else, then over and above those net assets, I will also get some premium for the goodwill, employee expertise, the business that I've set up, and hence the going concern value will be relatively higher as compared to the non-going concern value. So that is the essence over here. If nothing is going, we'll assume that the valuation is done on a going concern basis. Very easy, very basic. Next, we have valuation of distressed companies. Now, the valuation of distressed companies can be done, I mean, there may be a distressed company like you have a Go Air or a Jet Airways, for example, which are or which were facing, let us say, distressed situations. They were unable to service their debt. Maybe they were unable to pay their loans, installments, etc. on a timely basis, and then hence we can say that they are under distress. Now, why can't traditional valuation models apply over here? Because traditional valuation models assume a valuation continuing up to a company which continues up to perpetuity. Like DCF Gordon's formula assumes that the company continues till perpetuity. But if a company is under distress, probably it might not be able to continue till perpetuity, and hence you might need to adjust these valuations. You might have to make certain adjustments to these valuations. Again, if there is a distress sale that I have to do, even my net assets may not fetch me what they should have fetched. Like if I want to sell my house, I will have to search for buyers. I have enough time. I will take various bids. However, if I have to generate money immediately, I have to do a distress sale. I'll have to sell the house at whatever value I get, and hence that might also be potentially lower. So the valuations that may be there using by the standard valuation approaches, that is the income approach where you look like something like DCF, or the asset approach, or even the relative value approach where you kind of look at your P multiple or EV by EBITDA multiple. In case of a distressed company, you cannot directly take the multiple of a other flourishing company. Like Indigo might be doing really well, so multiple of Indigo cannot necessarily be applied to, let us say, a company like Go Air, as we speak at least. So over here it is a little difficult to apply these values directly, and hence you might need to do certain types of adjustments. So initially the institute tries to explain why we can't directly do the valuation basis that we were using earlier, and how do you make these adjustments. So over here, for the method of valuation, there are three different things. The first is you calculate something called as a modified discounted cash flow valuation, where you try to modify the cash flow considering the probability of distress. Probability of distress can be derived using various things, but from an exam perspective, let us say the probability of distress would be given. It is a probability, in which case over here we will try to modify the cash flows. We will say that, well, you know what, generally I was expecting that I will receive 100 rupees, let us say, in the first year. However, there is a possibility that I might default. What is the possibility? Let us say 20%. So if the probability of default is 20%, then there is no default probability of 80%, and hence you might try to modify the cash flows after considering the probability of distress. So you might say 100 is a cash flow, but there's only an 80% chance that this cash flow may be attained. And as a result, while you're doing a valuation at each year, you will take the probability of distress and accordingly try to find the cash flows, which are the modified cash flows, and then discount it. For this, if you kind of take a reference base, you might have something like the certainty equivalent approach. If you're aware, when you study your advanced capital budgeting, there's certainty equivalent, where you take your total cash flows into, you multiply certainty equivalent in order to find the certain cash flows. In a similar way, you have the cash flows, you may be given, let us say, a probability of distress or default, and you multiply, let us say, 1 minus the probability of default to find the cash flows had there been no default, and that will be your modified cash flow, and that modified cash flow will be used for the purpose of valuation. I hope you understand that if there is an 80% probability that there will be no default, then even if you are expecting a 100 rupee cash flow, your modified cash flow after considering the probability of default would be 100 into 0.8, that is 80 rupees only, and accordingly the valuation will be done based on 80, and hence it may be a slightly lower value as compared to a value which would have derived had there been no distress. One option is you adjust the cash flows. The other option is obviously you adjust the discount rate, similar to the risk adjusted discount rate method that you do when you do your advanced capital budgeting. There's a risk adjusted discount rate where you say that if the risk is higher, the discount rate is higher. In a similar way, if there's a distressed firm, it is obviously having a higher risk as compared to a regular operating firm, and hence the discount rate should ideally be higher, and hence you might either adjust the cash flows or you might even adjust the discount rates in order to consider the effect of the distress. So over here, this is valuation of a distressed firm using, let us say, a modified cash flows. Second is the DCF value plus the distress value. So over here, what you have a couple of terms, and we have kind of kept a question for that so that you understand it better, where this method says that, well, we don't know whether this firm will ultimately kind of liquidate or will this firm will continue. If it continues, the going concern value can be measured by something like a DCF value, a discounted cash flow value. But if it does not continue, then in distress, what will I get today is another value that you find. Now you will take these two values and take the average, the weighted average, where probability of distress will be taken as weight. So over here, you will try to find the DCF value. Let us say the DCF value is 100 and the distress sale value. If I were to, how do you find the DCF value like you have done in security valuation or business valuation? And then distress value, if I were to sell the asset on a fire sale, distress sale today, how much will I get? Probably 80 rupees. What is the probability of distress? Well, the things are going really bad. There's possibly a 70% chance that they will default, which means there's a 30% chance, 1 minus 0.7, that they will not default. And hence, if I were to take the weighted average, this is what? 30 and let us say, I think 56. And as a result, this will be, let us say, 86 on an average. This is how you will calculate. For this, we have kept a separate sum. I think this is question number 7 or 8, I think. Let me just refer question number 7. This is from the practical question section. I will share this on the Telegram channel. The description will have the link for the same. So you can refer that. Currently, let us say we go to question number 7. This is valuation of distress firms. So over here, due to the sudden onset of COVID-19 lockdowns, X Limited is under distress and requests you in assisting in the enterprise valuation and the equity valuation. Enterprise valuation will include the debt value as well. Equity value is after deducting the value of debt. X has a debt of around 2663 million. Okay. The going concern value, considering going concern assumption and applying DCF valuation, the firm value, that is enterprise value of the operating business of X, has been correctly valued at 5530. Now, we have not gone into the DCF valuation over here separately because you have done enough sums to kind of find the present value of future cash flows. Let us say 5530 was calculated using that. The distress value, this is the new part. The book value of the assets of X today is 14531. This is book value. But is it necessary I will get that? No. It is estimated that the distress sale proceeds will be 30% of the book value of the assets only. Maybe the fair value is lower. Maybe you might have to sell it at a very lower price. Let us say 30% is given. We'll take that. Based upon how much assets of other bankruptcy firms were being received in the marketplace currently. So your going concern value is 5530 million. Your distress value is 14531 into 0.3. 14531 might be the book value. However, if you multiply into 0.3, you will get, let us say, around 4359. So let us say 4359 is the distress value. Do I consider only one of them? Well, we don't know what is going to happen. Further, the estimated cumulative probability of distress for X Limited is 76.63% over the next 10 years. How is this calculated? There are various ways, like you can look at rating agencies. Rating agencies usually give a probability of distress, or you can use bond values or various other ways to find the probability of distress. Usually one of the most popular ways is to look at rating agencies and see what is the probability of distress they are assigning and accordingly do the valuation. So over here, if I were to find the firm value or the enterprise value, I will say 5530. There is one possibility, and 4359, that is another possibility. But 4359 you will get if there is a default distressed value if I were to sell everything, but that is a 76.63% chance. However, if I continue, I will get probably 5530. This is having a 1 minus 0.7663 chance, and hence if I were to total, this is what? If I were to total both of this, you will get approximately 4633 million on an average. But this is the firm value. If the question requires you to find the equity value, your equity value over here will be the firm value, that is 4633 2333 minus the debt value, which in this case is 2663, and hence that is around 1970 million. So that is about it. It is just that if you have not done this problem, you might feel very scared on what will happen if there's a distress value. It is very easy. I mean, it is a liquidation value that you are expecting to get, and you will have a probability of distress. You consider both of them and you will get the equity value. If you have the number of shares, you divide by the number of shares in such a case. So this is question number 7. I would want you to refer this. Second, you have something called as adjusted present value. Now, we are not going to go on to the merits or demerits of this method. We are just going to say that if this comes in theory or in a numerical, how should it be calculated? What should be our application base? So over here, when you look at the adjusted present value method, they say that again the valuation base over here will be starting as if the firm is operating fairly well. Going concern value, they call this as unlevered firm value. So let us say if the firm is going well, it does not have any separate debt risk, etc. What will be the unlevered value? So that will be typically given to you. Otherwise, you can calculate it using the present value of future cash flows or the valuation method given. Unlevered value is the value ignoring whether the company is financed or having debt or equity, etc. However, if the company has debt, they can get some tax savings, and hence on the unlevered value, this method says you can add the tax savings that you can obtain from debt. This is similar to, if you remember in your CA Inter, when you study Modi-Gilani-Miller method, if you have done in capital structure, where they find the unlevered value and then they say that, well, if a company has taken debt, that debt will give them tax savings due to the interest deductions. Again, it is possible only if the company is generating enough future cash flows where it can get the benefit of debt. Some companies may be loss making, in which case there might be no notable tax savings, but if there are, then you should take. So the formula over here would be the firm value will be the unlevered firm value, which is the same value as if it is a going concern, ignoring debt and ignoring any capital structure effects, plus the tax benefits of debt. Well, usually that can be calculated as the debt into the tax rate, if that is the case, available, minus, this is a new term, expected bankruptcy cost. Now, how is it calculated? Well, it is calculated, expected bankruptcy cost is the DCF value or the unlevered firm value minus the distress value. Like in the last problem, 5590, if I am not wrong, was your DCF value, and the distress value was around 4,300 or something, and hence the difference between the two is the cost that you are bearing if you were to liquidate under distress. So that is called as the expected bankruptcy cost. So how do you calculate the expected bankruptcy cost? The difference between these two. So if you see, expected bankruptcy cost can be calculated as the difference between the unlevered firm value and the distress sale value. So unlevered firm value and distress sale value into the probability of distress. It is not necessary that you are necessarily going to default, but if you do, then considering the probability of distress, what will be the expected bankruptcy? So this is your adjusted present value model, for which we have, I think, kept a question number 8. So if you refer question number 8, let us go through the question number 8 for this. Now, due to the sudden onset of COVID-19 lockdowns, again X is under distress and has a debt of 2663 million. Same. The unlevered firm value is given to you as 14,211, which is a firm value, let us say like an enterprise value. Just that the word used is unlevered debt value, we are keeping the same word. So if something like this comes in a small MCQ, you should not be baffled. You say, okay, this is your same enterprise value. We assume no significant tax benefits to accrue. Okay. The distress sale proceeds are expected to be 4359 million. Some different value is given, 4359 million. Compute the bankruptcy cost and adjusted present value for enterprise and equity considering the cumulative probability of distress over the next 10 years is 76.63%. Almost similar numbers we have kept. So if I want to find the expected bankruptcy cost, so the expected bankruptcy cost will be calculated as, let us say, 14,211 minus 4359. So this is your total, 14,211 minus 4359, 9852, but into the probability of distress 0.7663. So if we do this working, this is 14,211 minus 4359 into 0.7663. So that comes to approximately 7550. Approximately, maybe there is some rounding of differences, but 7550. So that is your expected bankruptcy cost if it comes, and then the adjusted present value for enterprise and equity. So over here, the enterprise value can be calculated as the unlevered value, which is 14,211, plus the tax savings that you are expecting on debt. Typically that will be the debt into the tax rate. Here they are saving that there is no tax savings, so this is plus 0 minus, let's say, $7550. So if I subtract this 14,211 minus 7550, approximately that is around 6660 or 61 as the case may be. So this will give you your value of 6661 or 6651 or 61. Maybe there is some calculation working here or there, some rounding of differences, that is fine. And if you want to find the adjusted present value for the equity, so the adjusted present value for the equity, I think यहाँ पे instead of 7550, this is 7560, and according there is a $10 difference, so this is 6650. Okay, and then you have adjusted present value for equity. So whatever is your enterprise value, from that you subtract debt, and that will give you equity. So that is just about it. Nothing to be really scared of. These are two new things where you need a problem. For the modified cash flow, we have mentioned over here that for the modified cash flow, you can do it in a manner similar to certainty equivalent or the risk adjusted discount rate method, for which you have separate sums in advanced capital budgeting. Another method over here is the relative valuation method. So if you see the theory, there's another method which is a relative valuation method. What happens in a relative value? You take a comparable company. Let us say there's a telecom company which is under distress, which is on the verge of closure. You will try to find the value of this company. You will take comparable companies like, let's say, Vodafone, VI. I mean, hypothetically, it is kind of in some distress, but let us say it is under some distress. I will take a competitor company like someone like a Bharti Airtel. Let us say they are trading at a multiple of 2 times. Can I give the same multiple to Vodafone? The answer is probably no. I will have to kind of filter down the multiple. I'll have to make a subjective assessment, maybe take it down to, let us say, 1.25 and do the valuation based on that. So over here in relative valuation, it is still going to be the same. If you're taking, let us say, sales as a metric, sales into EV by sales, or if you're taking EPS as a metric, EPS into PE ratio. However, you cannot directly take the PE ratio of the competitor. You might have to make certain adjustments depending on how likely it is that you will face a problem, and accordingly find the value. Okay, so over here, this is also a method which you have done multiple times. So basically, you just take your sales into the adjusted EV by sales ratio, and that is about it. And the adjusted EV by sales ratio is the EV by sales, let us say, of a competitor minus, let us say, certain subjective adjustment that you will do to consider the fact that this is a distressed company. So valuation of distressed companies, 4 methods: modified cash flows or modified discount rate. Second, the DCF value along with the distress value, where you take the weighted average. Third, adjusted present value, where you take the unlevered firm value, plus you will take your tax savings on debt, minus you will subtract the expected bankruptcy cost. And as per this method, the expected bankruptcy cost is going to be the unlevered firm value minus the distress value into the probability of distress. We have a numerical for that. And the relative value, you just take the EV by sales into the adjusted EV by sales adjusted into your sales, as the case may be. So I hope this discussion has been helpful in kind of cooling your nerves a little when it comes to valuation of distressed companies. Next, you go to the valuation of startups. Again, they've just given you that basic theory everywhere, that why can't we directly use the valuation methods as we have studied earlier. The income approach. Well, income approach will focus on calculating income, but the problem is, for a startup, calculating income, cash flows there might be a lot of negative cash flows, so it might be a little bit of challenge. And again, it is very difficult to forecast at an early stage that what will be the possible cash flows. Second, when you look at an asset approach, startup inherently does not have a lot of assets. It has a big, maybe disruptive idea, but not a lot of assets. Like WhatsApp, when it got acquired for close to $15 to $20 billion, had barely 55 employees, an office or two. Instagram had 7 employees when it got acquired for $1 billion. And that ways, if you do an asset based valuation, that is not going to give you the right value at all for these startups, and because their intellectual properties, largely their asset, which is not kind of separately appearing anywhere. And then is a market approach. Among all the approaches, if you see for valuing a startup, one of the best approaches would be the market approach, where you will kind of try to take a multiple of a similar company, comparable company. You might not have a similar company in your country. You might look at an international comparable, or maybe a similar company and make certain adjustments for differences in your quality, features, etc., and then use it as a base. If you have kind of viewed Shark Tank, or at least the clips, etc., of Shark Tank, you will see that a lot of times they kind of mention that if this is your revenue, then ideally as at a 2 times multiple, this should be your valuation. So you would hardly listen to the sharks who are trying to do a cash flow based valuation or a Gordon's based valuation or even their asset based valuation. They are more talking about kind of revenues, not even profits, because these startups might be in losses, and then trying to ascribe a multiple and then doing a valuation. So over here, the closest among these three, I would say, is the market based approach. Again, the problem over here, as we have highlighted, is all of these methods that we see presuppose that the business is established, startup is not at all established, profitability is not certain, and as a result, these values directly may not be used for the purpose of startups. Even historical data may not be separately available. Okay, the major roadblock over here for startup is the absence of past information. Why traditional methods cannot be applied? We said in income approach, not generating enough cash flows. Asset approach, they are negligible assets. Market approach, you might not necessarily have competitors to kind of benchmark your product against. Now, for that, you will have to see what is your value driver, what is your differentiated offering. So over here, if you look at your value driver, it is either the product, the uniqueness of the product that you have, which can kind of drive the value, because currently income assets are negligible. So your product, the uniqueness of your product might drive the value. Management, one of the most important things for a startup is the management, the track record, the resilience, the fire in the belly that the management has. You see, if you, again, I mean, I know that this is not the right time to talk about Shark Tank, but if you kind of have listened to pitches on Shark Tank, a lot of times these sharks, which are kind of a proxy for the investment community, get really sold on the management team, the story of the management, and hence that is also an important value driver, as we call it. Traction would mean this is for companies who have started generating revenue. How well is a product accepted by the customers, etc., that can show the traction. Revenue, if any, which is generated. A lot of ideas are pre-revenue as well. If they're pre-revenues, maybe this revenue cannot be used, but if I've started generating revenue, then that can be used for the purpose of valuation. Industry attractiveness, there are various terms that are there where we try to gauge the size of the market. A lot of people look at the size of the market to figure out whether it is a good opportunity. You might be a small fish in a relatively big pond, in which case you will still get a reasonably good traction with the audience and hence a reasonably good revenue. Demand, supply, and competitiveness. First mover, if you're a first mover, then nothing like it. You really get a lot of benefits, but even if you're not, if your competitive landscape is relatively less, you have lesser competitors, then that will be a much more higher value driver. So these are possible reasons: your product, your management, traction with the customers, demand, supply, industry attractiveness, competitive environment, etc. Okay, methods for valuing startups. Again, when you look at these words, you kind of get Burkus approach, first Chicago method, etc. Remember, they are very easy workings. Okay, if you just kind of spend another 5, 10, 15 minutes on this lecture, you should be fairly comfortable. So there are 6 to be precise methods which the institute has outlined for you to kind of value a startup. First is something called as a Burkus approach. Now, Burkus approach was derived, or not derived, it is kind of given by Dave Burkus, where he identified 6 or 5, I think 5 crucial factors, and he assigned a subjective $5 lakh or $0.5 million value to each of these factors, depending on how attractive your company is vis-a-vis these factors. So what are these factors? First is the basic value. This is something like the idea. How good is the idea? If the idea is fabulous, probably I will be willing to put in $5 lakh merely for the idea. But if your idea is an average idea, a 50% kind of weight I put, then I will say, okay, it's a decent idea, not kind of a path-breaking one, then 5 lakh into 50%, that is around 2,50,000 attributable to the idea. So I'm putting 5 parts and I'm saying that the value of the startup is the total of these 5 parts. There will be shortcomings in this, but nevertheless this is a value if it comes in the exam. Second is technology. A lot of startups are now technology driven, and if you have really good technology, really unique, then I'll be ready to put in $5 lakh for the technology. Again, average technology, very low level of technology, then maybe 20% for the technology maybe. Execution, what is your track record, etc. How have you performed? So execution will be seen. Strategic relationships in the core market. Have you got contracts? Have you got orders? Have you established some contracts with existing players? And lastly, product and consequent sales. Remember, if you're a pre-revenue company, there is zero revenue and hence the last value will not be there. So what the Burkus approach, and again there's a lot of drawback over it, is highly subjective, but if it comes in the MCQ, we are going to get our 2 marks, or if it comes in a small descriptive. So the maximum value, which is the range of value for each of these items, the basic value, the technology, the product, sales, etc., execution, and the strategic partnerships, each of these have been subjectively given a $5 lakh value, which means a maximum value for a revenue generating startup under a Burkus approach is $2.5 million, that is 25 lakhs, because that is a maximum value as per Dave Burkus. For a pre-revenue company who is just having an idea, some technology but not revenue, then revenue will not be considered, in which case you will have maximum value of $2 million, that is let's say $20 lakh. So that is what they have mentioned. This is based on the 5 crucial factors. It is a fairly uncomplicated tool, but something which is not necessarily the best way. So if we kind of look at let us say the sum on this. So we go to question number 1, fairly easy working. The Burkus method. Over here, the Burkus method of valuation assigns value to a business idea and each of the company's principal success factors. Each category counts for a maximum of $5 lakh. X is being valued under the Burkus method and is having the following features. So basic idea, I look at business idea 50%. So this is 5 lakhs into 50%. Existing of a prototype, well, you have developed some technology, some sample is there, 30%. Strong management, so that is 75%. Strategic partnerships are 60%, and product has started to roll out, so 30%. So basically your valuation will be, let's say 5 lakh into 0.5 plus 5 lakhs into 0.3 plus 5 lakhs into 0.75 plus 5 lakhs into 0.6 plus 5 lakhs into 0.3. And hence this comes to around $12.25 lakhs. So your valuation under the Burkus approach for this startup is, let us say, 12.25 lakhs. A fairly easy thing if you have studied. If you have not, then you will lose some easy marks over here. The next 2 methods are very basic. One is a cost to duplicate method and second is a comparable transactions method. Cost to duplicate is not a very popular method, but the method says that what was the cost incurred by you to build this startup. Cost incurred. Maybe the cost was incurred to buy assets. Maybe the cost was incurred to kind of do some research. What is the cost incurred? Now, the criticism of this method is you're not kind of considering the intangibles or the values otherwise. You're just considering on the cost incurred. But if it is to be valued like that, then what is the cost incurred to duplicate or create a similar startup? That would be one of the values. And then is a comparable transaction method. Again, like we discussed for your distressed firms, if you look at identify a comparable transaction and then probably develop a metric, like in WhatsApp, you figure out that how much did Facebook pay for one user of WhatsApp. So if there is another, let us say, a platform like a Telegram which is getting acquired, they can figure out that, okay, we are not revenue generating per se. So how much did Facebook pay for one user of WhatsApp? So on an average, making certain adjustments, an acquirer should be ready to pay almost a similar value even for per user of Telegram, let us say. So over here, this is a comparable transactions method. 2 very basic problems on this. If you were to wrap that up, if it costs $5 lakh to recreate your startup's physical assets and $2 lakh in R&D expenses, what would be your valuation under a cost to duplicate method? Well, the total of these two, which is $7 lakh, will be the valuation under cost to duplicate. Similarly, question 3, this is, I've kept the same example as there in your study material. XYZ, a logistics startup, was acquired for 560 crores. It had 24 crore active users, so 560 divided by 24, if I were to find, this comes to approximately 23.33 per user. Okay, you are required to value ABC using relative valuation, which is another startup with 1.75 crore users. So if it is 1.75 crore users, 1.75 into 23.33, that is approximately 40.83 crores will be the value under the comparable companies method. Okay, next you have scorecard based valuation. Now over here there are close to 6 or 7 parameters that have been identified, and for each parameter a weight has to be subjectively assigned. So again, the parameters are broadly the same. You'll have your team, the technology, the competitive landscape, the need for additional funding, etc. We will discuss those pointers, but to each of these pointers you will subjectively assign. However, when you look at the Burkus approach, we had said that okay, almost equal weights for each of them. Here it is not the case. We have given more weight to maybe management team, more weight to the industry size, that is the size of the opportunity, relatively lesser weight to other factors like need for additional funding, etc. So how do you define these scorecard related weights? It depends on each product, each market, each opportunity. So what we will try to do is we will try to find the average weight of your company vis-a-vis the average industry company. So you will look at an average comparable company in your industry. You will say the average comparable company in your industry is valued at $5 million. So ideally we should also be valued at $5 million. Well, not necessarily. We will make a scorecard that how good or bad you are vis-a-vis the average comparable company in the industry. Let us say it on an average comes to 1.5 times weight, then 1.5 into 5 million, that is $7.5 million should be your value, or it comes to 0.75, then 0.75 into 5 million, that is $3.75 million is your value. So the scorecard method is another option for pre-revenue businesses. It works by comparing the startup to other already funded startups. So what are the criteria? The strength of the team, the size of the opportunity. So you can give anywhere between 0 to 30% weight to the team. Maybe you can say team is worth 20-25%, or size of the opportunity, product or service, competitive environment, marketing, sales channels, need for additional funding, and others. So if it comes as a theory question, you will have to kind of remember at least a lot of these points. Similar to Burkus value, you have the team, you have the size of the opportunity, you have the product or technology. Instead of partnerships, you have collaborations, etc. A couple of additional points like the need for additional funding, etc. Once you do that, you will multiply you will find the weight of your company vis-a-vis the average company which is funded in your same locality or sector, and then you will find the value. The best way to do this, again there is some theory over here, is to again understand this with the numerical, which I would say is slightly more important. I don't know, we missed the first Chicago method by any chance? Okay, first Chicago method is after this, no problem. So we'll first do the scorecard method. I think this is question number 3, 4, 5. Okay, question 6. It's a fairly detailed question, but it's much more easy to understand. So ABC is looking for angel investors to raise capital for the company. The interested investor drafts a scorecard company valuation for the target company ABC Limited. So you have these parameters which are given. One should read this, and the venture capital firm gives the following weights to each of these criteria. Okay, so the size of opportunity is 20%. So you could have given anywhere between 0 to 30%, 20%, board entrepreneur management team is 25%, etc. So this has been given. In this case, the pertinent average of local comparable company valuation is $7 million. So the average company would give you $7 million. So if you are also the average company, you will get $7 million. Find the value of ABC using the scorecard method. Are you the average company? Well, the size of opportunity is 20%. You have large market opportunity. You are in a market which is, let us say, so over here, if you see 20% into 140%, your team is much more stronger. So this is 25% weight to the team. Average technology, so on the technology, the weight is 20%. So this is 20% over here. Marketing and sales, 11.5%. So here you have been told, on the other hand, management was facing problems with the sales channel. You don't have as good a sales channel. They need to work on establishing the sales channel and hence build partnerships. So On the sales channel, you are slightly lower, a notch lower as compared to the average company. So that's just a 90% as compared to the average norm. When we look at ABC strength of market competition, it is again weaker as compared to the others, that is at 80%. Again, we have assigned 11.5% value to that. Need for additional funding is similar to that of the norm, this is 6%, and early feedback from the customers is excellent. Therefore, again, this is almost equal. So this, I mean, this is just data given. What you just have to do is kind of, you have to take the weighted average, like you look at the size of opportunity, 140 and 20, 130 and 25, 100 and 20, you multiply these, and on an average, so the total of all of these will ideally come to 100%. So we are saying that on an average, these are the weights to each of these factors, and your target company as compared to the average company is 140%, that is 1.4 times better, or it is 80%, that is 0.8 times only. If you take the weighted average, this is around 1.1205. So your company is around 1.1205 as compared to the average company. The average company has a $7 million valuation, $7 million into 1.1205, and you should come to 7 into 1.1205, which comes to around $7.8435 million. This is your valuation under the scorecard approach. So basically, under the scorecard approach, you will have around 6 or 7 factors where you will assign probabilities, and then you will compare your company as compared to the average industry player on each of these parameters and find your overall weight as compared to the average company. So if you are 1.12 times better as compared to the average company, then your valuation should be 1.12 into $7 million, that is $7.84 million, as you can see over here. This is $7.84 million. Okay, next you have something called as the first Chicago method. This is nothing but a scenario analysis that you do in capital budgeting, where you will try to find the value under 3 different scenarios: the worst case scenario, the base case scenario, and the best case scenario, and then assign probabilities to each of these scenarios and just do a probability based weighted average. The name is fancy. It is like long and short. Or a short, what does short mean? Short means sell, long means buy, just financial jargons as you call it. So in a similar way, first Chicago method is nothing but scenario analysis. You will find the value under 3 different scenarios and then probability of each of these scenarios, and weighted average of that is the value under the first Chicago method. So over here, if I were to do a question on this, I think this is question number 4. Following are the range of values under the DCF model for a growth stage company under the 3 different scenarios. First is a base case scenario, $120 million, that is 60%, upside case, downside case, and with the respective probabilities, find the value of the growth stage company using the first Chicago method. This is nothing but another name for scenario analysis. $120, the probability of 0.6, $180, the probability of 0.25, $50 million, the probability of 0.15. And if I were to do this, this is close to, I think, $125 million, which is the value under the first Chicago method. Okay, and the last is the venture capital method. So what happens, for example, in a venture capital method, the 6th method, over here, the venture capital firm will seek a particular value at the end. So this is a little interesting, I would say. So the scorecard method, the venture capital method, the distress based values, these are a little interesting. So over here, the venture capital fund will try to find the value based on a possible exit multiple at the end of its investment horizon. So let us say it wants to invest for 5 years. After 5 years, what will be the income or sales of this company into what must be the prevailing multiple then? So that will give you the exit value. But so that is a value that you are expecting to get after 5 years. But usually the hurdle rate or the required rate for the venture capital fund is quite high. I mean, maybe 20, 25, 30%, because they are investing in much riskier companies as compared to, I mean, I will not be happy at 10, 15%. I might as well have invested in regular large cap equities. So over here I need more, and hence I'm going in the private company or venture capital or startup space. So I'll expect kind of a IRR, and hence what I will try to find is, I will try to find the value today, which is after considering the present value based on the value that is derived. So it is sounding to be very confusing. Yes, if I do this in a numerical, it will be very, very easy. You would have probably done that even in business valuation, just that we did not call it as a venture capital method. Let us refer question number 5 over here. A startup company is seeking to raise $8 million for its Series A investment round. Okay. For the financial forecast, the startup is expected to grow to $100 million in sales and $10 million in profit by year 5. Okay. In terms of the expected exit date, the venture capital fund wants to exit in year 5 to return the funds to the investors, that is the limited partners. The company's comparative peers are trading for 10 times the earnings. So over here, what happens is the startup is expected to grow to $100 million in sales and $10 million in profit in year 5. So this is what the expectation is. Again, the exit date for the venture capital fund is identified as year 5, and in year 5, it is likely that the startup will have $100 million in sales and $10 million in profit. VC wants to exit in year 5 to return funds to its investors. The company's comparable peers are trading at 10 times the earnings. So over here, your exit value, ideally, it is 10 times the earnings, not 10 times the sales. So $10 into 10, so probably this comes to $100 million exit value, which is at year 5. So the fund should get $100 in valuation of this company at year 5. The VC firm's desired rate of return is 30%. So if the firm has to get a value of 100 million after 5 years, its value is not 100 million today, it is after 5 years. If I want to earn an IRR, so my future value is 100. So when I look at the compound interest formula, I say future is equal to the present value into 1 plus r raised to n, where I know that the future value now, I'm expecting $100 million equals to the principal amount, let us say P, I don't know the value today, into 1 plus r. As you see, the desired rate of return is 30%. So on a per annum basis, 30% return for a period of 5 years. Therefore, $100 equals P into, let us say 1.3 into raised to 2, 3, 4, 5. So this is probably into 3.7129. Therefore, the value today would be 100 upon 3.7129, which comes to around 26.93 or around $27 million. But this is the value today, provided the venture capital fund does the funding. This is called as post money value. Post money means after my investment, what is the value? Yeah, but I am investing $8 million. So over here, the total value is 27 after my investment, which will grow up to 100 million after a period of 5 years at the rate of 30% rate of return. So this is 27 million, my post money valuation. So if I want a $100 million valuation, which gives me a 30% average rate on the money that I invest, the company today should be valued at $27 million. 27 growing at the rate of 30% for a period of 5 years will reach up to $100 million, and this 27 million is after my investment. So this is called as post money valuation. You must have heard these terms probably in valuation. Post money, that is after. Post your 8 million valuation. Therefore, your pre-money valuation before you invest, the valuation must be 27 minus 8, that is equal to $19 million. So over here, we will say that, okay, if my exit value is 100 million and my discount rate is 30%, then today the value should be 27. But this 27 is the post money value. If they ask you, this is after considering your investment. If you subtract your initial investment of 8 million, you will get a pre-money valuation of $19 million. The question also further asks you that how much stake should the VC take in the startup? Well, if the VC is investing 8 million, after its investment, if the value is 27, then ideally 8 divided by 27, this will come to approximately a 30 or a 33% stake, as the case may be, which they will demand in this startup. This is one particular problem which you'll probably want to go back to and understand it slightly better. Okay, so this is your question number 5, and with that you have done the methods, the 6 methods under the startup valuation: the Burkus method, cost to duplicate method, comparable method, first Chicago method, venture capital fund method, and the scorecard method. Now, if someone asks you these methods, hopefully you should be very confident and not really, or there is a new topic we don't know, institute has not given numericals, that's fine, but we can have some basic understanding and understand these methods and even appreciate how, if you become a shark, how you can do the valuation, right? Okay, I'm sure you will become a shark. So this is how you will do. Also, there is ongoing concern valuation. There's a question 9. I would not really put too much behind this. We'll just quickly read this. X has the following balance sheet as on 31st March 24. So this is land with a fair value of 5,000, machinery and cash, equity, capital, reserves and loan. It is expected to generate a super profit of 1,000 per annum in the foreseeable future. Okay. Goodwill is measured based on 5 years of super profit. Find the value of X using the net assets method. This should be very easy. So if nothing is given, we will do the valuation considering the goodwill as well. So which means this will be 5,000 for the land plus 2,000 for the machinery plus 1,000 for the cash minus 2,000 for the loan. So if I go to see, this is 5,000 plus 2,000 plus 1,000, that is 8 minus 2, so that is 6,000. However, there is some goodwill as well. Well, this is measured at super profit into number of years purchase, so 5,000 must be the goodwill value. And hence, if I total all of this, it will come to probably 11,000. So this must be the value of my company. Would your valuation change if there's an order by the government to immediately close the company and no other company is permitted to take over the business of this company on a going concern basis? Let us say something like TikTok happens, where let's say TikTok has this value. However, now the government says that you'll have to close this, you cannot sell it to anyone, in which case, well, all else remaining constant, you can still sell the assets on a piecemeal basis, not on a going concern basis. So you will get 5,000 plus 2,000 plus 1,000 minus 2,000, which is equal to 6,000, assuming there is no further kind of a markdown due to this distress sale. You will still get 6,000. So your going concern value will be 11,000, which will include the value of goodwill. The value of a non-going concern will probably be around 6,000. That will not really include the value of the goodwill. Okay, so this also takes care of the non-going concern valuation. Next, you go to the valuation of digital platforms, then valuation of let us say I think professional firms. Not very important. There is quite a bit of theory. We'll discuss that. But there is impact of ESG on valuation. I would put this as important. I've kept a separate sum for this, 2 sums for this as well. So this is something which is important from an exam perspective. So what is ESG? It is kind of a buzzword today. E for environmental, S for social, G for governance. So over here, ESG is now a very important consideration for Indian and also a lot of international investors. So when we try to value a company, we consider its ESG impact, the ESG impact that it creates. Like, what is the environmental impact? Does it actually result in damage to the environment, or is it taking actions to kind of protect the environment? Water, environment, air, etc. The social impact, how does it treat its labor? Governance, is the board fairly independent? Are they trying to siphon off money, etc. for the management, etc. So the corporate governance. So these 3 are fairly important things. So over here, when you look at ESG, in ESG, you generate value for all organizational stakeholders, environmental certain examples, social certain examples, governance certain examples. Now it is on the radar of the investors. They clearly mention, and rightly so, that now it is, earlier it was good to have. Now it is kind of a must have, because a lot of international funds will not invest money in your company if you have an ESG score below a particular level. And as a result, ESG is now of a very high importance. Like what happened to Adani when the Hindenburg report came, there was questions on its governance, so its ESG score went down, in which case the bigger funds, even if they like the company or they don't like the company, as per their mandate will have to exit this company if their governance score goes below a particular level. So over here, that similar thing can also happen for social or maybe environmental causes. So this is something which is fairly important. A lot of funds now are raised considering ESG. So maybe they've just mentioned some important numbers where they've said investment in excess of $50 billion in pure ESG funds. Green bonds, there's a new concept where a green bonds has come, and they have kind of even crossed the $1 trillion threshold. Sustainability, taxonomy, so tax, etc., incentives, rules framed to kind of incentivize environmental impact. Convergence of ESG framework with IFRS. Now when you look at your financial reporting, currently it is not there, but institute is in the works, IFRS, ICAI, everyone, to kind of have a sustainability report, and hence there is a convergence. IFRS along with your annual report will require also a sustainability report, and SEBI is requiring the companies, at least the listed ones, to give their ESG compliance, etc. Remember, better ESG is good for the company, better governance, better social impact, will have better morale of the employees, etc. And thereby it will increase the value of the company on a sustainable basis, on a long run basis. It will help in achieving organizational goals on a long term basis. So this is something which is kind of important. Now, in terms of valuation, how will you incorporate the effect of ESG in valuation? One of the two ways. First, we'll either adjust the discount factor, considering probably if I have lower ESG values, then there will be a premium. My required rate of return will be higher in such companies as compared to companies which have better ESG values, or vice versa. So again, it's a fairly easy adjustment. Most companies prefer doing that directly. It's a much more simpler adjustment. Or another possibility is to adjust the cash flows. How will we adjust cash flows? We have given kind of an example over here. We have kind of taken a numerical, built up a numerical example, considering the impact that ESG actions of a company might possibly have in their free cash flows. Generally, theoretically, it is preferred if you do an cash flow based impact for the ESG. So over here, what is the impact of these factors? How can they be incorporated? E for ESG, it can be incorporated, the environmental impact, by doing a 2-degree scenario. A 2-degree scenario means what will happen if I increase the temperature of my plant, for example, by 2 degrees. What impact will it have? Will it result in me having to pay some additional penalties or having to buy some new equipment, etc.? Will there be an additional cost because of that? Social impact, like if I exploit my labor, in which case if they might go on strike or it might affect my revenue. Governance impact, like if you kind of do some non-compliance, in which case you might have to pay penalties, etc. to the government. So all of these put together can have an impact on valuation, where we have, I think, put question 10 as well as question 11, the last two questions on these two particular aspects. So if I go to question number 10, impact of ESG on valuation. 10 is very basic, 11 I would say slightly more important. So X operates in the telecom sector and is fully equity funded. Okay, it has calculated its cost of equity using CAPM at 15% without any ESG adjustments. So RF plus RM minus RF into beta directly at 15%. In a conference, the CEO of X realizes that investors consider ESG scores while determining the cost of equity. The average ESG score of players in the telecom sector is 25. However, X has a lower score as compared to the industry, indicating a poor ESG position. A poor ESG position means if people are investing in your company, they will require more because they are bearing a higher risk. It is suggested that investors would adjust a 2% premium for the same while calculating the required rate of return. Calculate the ESG adjusted cost of equity for valuation of X. So over here, this would be, let us say, 15, which was my regular CAPM based value, plus a 2% premium. So my discount factor will be 17, and hence it will push down my value. If my discount rate is higher, cash flows remain the same, my value will go down. However, if my ESG performance is quite good, then maybe people will be happy even getting a percent less, let us say, than 15%, in which case my value might go up as well. So over here, this is question number 10, adjustment on the discount rate. Question number 11, if we see question 11. So following is the expected free cash flow calculation for X for the year 24-25 before making any ESG adjustments. This is for cash flows. Operating revenues less operating costs including depreciation. So this is EBIT, no interest, so it's a debt free company. 600 is the PAT after taxes, add depreciation less regular capex and working capital changes, and this is a free cash flow. Perfect. Following additional facts are assessed post an ESG survey. Environmental impact, the additional investment of 50,000 will be needed to mitigate the impact of a 2-degree scenario. So if you do something whereby your plant operates at a higher temperature, for example, you will have to incur some additional cost which is worth 50,000. Social impact, reduce sales of 200,000 due to social backlash associated with bad reputation because of poor treatment of employees. So that will push down your revenue by a further 200,000. This is before making any kind of ESG adjustments. So if you make adjustments, the value will be slightly different. Governance impact, due to non-compliance, additional penalty payment is 40,000, which may be imposed by the regulatory authorities. Okay, so this is 40,000 for penalties. Find the ESG adjusted free cash flow that will be used for valuation. For simplicity, it can be assumed that the existing tax of 100 will remain the same. So if you want to find the ESG adjusted numbers, your revenue will be 1000 minus a 200 reduction, which will be 800. Acha, operating cost. So this is the social impact is taken. Operating cost, well, we don't really know. Let us assume this remains the same. So this is 300, which means your EBIT will fall to 500. Again, there is no interest. Taxes are told to be similar to be 100, but there would be some penalties as well. So there's a 40,000 penalty which I will have to pay. That is non-operating, but I'll have to pay because of poor governance. We have been told that tax remains the same. Tax could also possibly change if there's lower revenue and stuff, but for simplicity, let us say tax is the same. In which case, your ESG adjusted PAT will probably be around 360 rupees. Acha, but then, so this is, let us say your ESG adjusted PAT. This is ESG adjusted PAT. However, you'll have to still add back depreciation worth 100. The regular capex and working capital will be 150, but beyond that, another 50 will have to be invested to mitigate the impact of the 2-degree scenario, and hence that will be 360 plus 100 minus 150 minus 50. So this is 260, and this 260 will now be used for valuation. Instead of using 550, considering ESG impact, you will only have, let us say, 260 for the cash flows for the purpose of valuation. So over here, if you see the working, have highlighted or made it in bold the ESG impact. So these are the three items where we have adjusted the ESG impact, and consequent to that, your ESG adjusted free cash flow is 260, which will be used for the purpose of valuation. So this kind of takes care of the adjustment of ESG when we have to do valuation. Okay, the other two things in the business valuation section which are added is valuation of professional and consultancy firms. Well, this is firms like CA firms, advocate firms, or consulting firms like your MBB, McKinsey, Bain, Boston Consulting, etc. How do you value these firms? The valuation over here will be similar to your regular valuation. Now, usually you will try to predict your income, try to take the present value of those cash flows, and you will get the value of these firms. So there's nothing unique per se, except for the fact that these firms will have certain key performance index or parameters like KPIs, as you call it in HR language. So certain key performance indicators, if you are like McKinsey, Bain, etc. and BCG, have much higher KPIs as compared to the average consulting firm, so their valuation would be relatively higher. Similarly, certain CA firms would have a much higher KPI, their performance index, as compared to the average CA firm, in which case you will have to make certain adjustments considering those key performance indicators and other positioning vis-a-vis the industry to find the value of these professional consulting firms. But that is just about it. A few keywords like a key performance index, industry workings as compared to its competitors, valuation based on financial statements over here only, and that should kind of suffice. So over here we have not put a practical illustration because we have kind of said over here that the valuation will be done as per the commonly accepted methods, similar to questions done in other chapters, after making necessary adjustment based on the key performance indicators of the professional firm vis-a-vis the industry as compared to how good or bad it is compared to the industry. So you can just quickly read up this theory. I've tried to kind of mark up a few keywords that you can possibly use. Key performance indicators, KPIs, industry competitiveness or attractiveness as compared to peers, valuation based on audited financial statements, etc. are a few keywords that you can possibly remember. But there's no unique valuation per se problem in these professional consultancy firms. Next, you have the valuation of these digital platforms. Now, what are digital platforms? Digital platforms can be repositories. So these are basically software based online infrastructure products. Like WhatsApp is a digital platform, Google is a digital platform, let us say a payment gateway, or someone like a Razorpay or a PayUmoney is a digital platform, for example. How will you do the valuation, and what are the challenges that you face for this valuation? So over here, the number of interactions like your users, buyers, transactions happening, etc. can be a good base. Like in the logistics company, we said that the valuation is done based on the number of users. In a similar way, over here, WhatsApp ka valuation or Google valuation, etc. based on the number of searches, etc. can be a good valuation base. So over here, what are, first of all, digital platforms? Digital platforms may be someone like marketplaces, someone like Amazon or a booking.com can be a marketplace where the valuation base may be the number of buyers, for example, or the users. Search engine, someone like a Google can be an example of a search engine. A repository where people submit or kind of host their data. Someone like a Spotify, YouTube, etc. Can be a repository. Digital communication base, someone like a WhatsApp, for example. A digital community like a Facebook or a LinkedIn, for example. Or a payments platform like a Razorpay, GPay, etc. So these are what you mean by digital platforms in various ways. What are the challenges in the income approach? For these platforms, a lot of cash burn might be required, and as a result, they might not be generating profits. However, for their valuation, if your income is negative, it becomes slightly challenging to do their valuation, same as that of a startup, and hence you might have to do some top-down analysis or a bottom-up analysis. A top-down analysis, of couple of key terms over here that you can remember is total addressable market. You might have heard this term called as TAM, serviceable addressable market, or SAM, and service obtainable market. Now what are these terms if they come in MCQ? A TAM means total addressable market. So if I am a player in the education industry, my total addressable market is, let us say, how much? All the education space. Okay. Second is the serviceable addressable market. How much can I service? Can I service the entire education industry? No, I am servicing only the CA students. So my service addressable market will comprise of only the CA students, for example. And the service obtainable market. Now realistically, how much market share can I get? Can I get all the 100% students for my FR, AFM papers, etc.? Maybe not. And as a result, what is realistically my obtainable market? So that ways you can try to do the valuation considering. So this is top down. You look at the top, that is what is the total market, out of which what is the market that you are servicing, out of which how much market share can you obtain. These three are very important terms. If you Google up on your startup space as well, you will see a lot of literature written around these three terms, and hence it is a good candidate for maybe an MCQ or small theory question. What is a TAM? What is a SAM? What is a SOM? And I mean, if you just know what they mean, you can very easily, I mean, you have this talent, right? If you know what these terms mean, you can actually write pages and pages on it. But for that, you should know what it is. So even if you know what target addressable market or SAM or SOM is, that should kind of suffice. This is a top-down valuation. In a bottom-up valuation, you will say that, okay, this is a newly emerging, I'm such a small player, to kind of do that top-down analysis for me is not as addressable. For me, I will try to project my own revenues, my own costs. So from bottom, I will try to do the working for my company and not based on the overall industry metrics over here. So when I'm doing the bottom up working, my valuation is similar to that of a discounted cash flow valuation, where I take the discounting rate. While I take the discounting rate, I again calculate the cost of capital using methods like CAPM, etc. But I'll have to make certain adjustments. Maybe a CAPM I will take for an established player who is there in the industry. I may not be as established, and hence there may be a company specific risk premium. I've kind of highlighted that, a company specific risk premium. I might be taking the beta, etc. of a comparable listed company. I might not be as directly comparable. So a company specific risk premium may be added over there for this workings. Second, and the more popular method is like the market approach. It is the same theory which gets repeated. In a market approach, again, taking P multiple might be difficult because these companies might have negative cash flows, or you might have to take the appropriate multiple, like for example, for Google, the number of searches, for LinkedIn or WhatsApp, the number of users, or let us say for someone like a payment gateway, the number of transactions. You can use these kind of metrics like we have mentioned over here, like marketplace, the bookings made, payments, the active subscribers, community, the number of users, a repository, number of readers, etc. can be used for the purpose of valuation. The asset based approach, again, it is the total of the cost that is taken to build a platform. Again, this does not take into consideration the revenue generating capability, and hence this may not be, asset based approach is generally not one of the best ways to find the value of these emerging platforms. Okay, so this kind of takes care of these 6 new sections for which startups, distressed firms and ESG, in my opinion, are the more important areas. So when you are revising, if you spend this hour, so we have kind of taken an hour with all the 11 illustrations, theory, explanation of methods, everything. So even if you look at this should be a good return on the time that you invest. I hope this has been helpful. So this kind of takes care of the new theory along with practical sums for your business valuation chapter. Okay, now is that it? Is there any other things which have been added as well? Well, yes. we'll quickly discuss now the other theory. So if you want, we can, you can divide in part 2, or let us say I'll just continue in the same video only. This is the first part where we got done with the numericals along with business valuation. Now for the other important topics, we'll first finish off the other important topics where there is a startup valuation, where there are 2 areas where we need to kind of discuss. This is how now all pure theory. We'll try to wrap this up over the next 1 hour so that your lecture gets done in around 2 hours, 1 hour for business valuation, 1 hour for the other theory, and you should be good enough to kind of work around. So over here, first is in startup valuation, we have the concept of unicorn. This is something for which a small theory question or an MCQ can come. I probably have seen this in one of these MTPs or RTPs. What is a unicorn? Unicorn is a term which was derived in 2013 by a person called as, I think, Aileen Lee or someone, who represents a startup. Unicorn is that kind of a hypothetical or a mysterious, that horse or whatever, that animal which does not exist in reality, right? Okay, it's a hypothetical figure. So over here, this is given to privately held companies who cross a $1 billion valuation. So 2 essential ingredients of an unicorn is, it is a company which is privately held and it has crossed a $1 billion valuation. Now this was earlier, a decade back or so, quite rare. Now you see so many unicorns even in India. The first unicorn in India, I think, was in Mobi or someone, and then now there are close to 300 plus unicorns in India. A unicorn which crosses a $10 billion valuation is called as a decacorn. So जैसे decade रहता है, वैसे decacorn is a unicorn which crosses a $10 billion valuation. So will a unicorn, once a unicorn, always be a unicorn? No. If the valuation drops below $1 billion, like you see what happened to Byju's, if the valuation drops, it is no longer a unicorn. So unicorn is, till the time the value continues to remain greater than $1 billion. So over here, it's a privately held startup. Valuation crosses $1 billion. Emphasis on rarity of success, new technology, disruptive, etc. are features. There is another word which is called as decacorn, which is crossing $10 billion valuation. Okay, so this is a short note on unicorn. Then there is something regarding startup finance. So they have mentioned some features about, like, Startup India initiative was earlier there as well. Now you also have a Stand Up India initiative. So there are 2 things. One is the Startup India program, then the Stand Up India program. In the startup finance, now in our country, there is a lot of focus and emphasis which is also there on startup finance, where a lot of incentives are given, like the government gives tax holidays under section 80 IAC that we have mentioned over here. There is an electronic development fund, exemption from angel taxation, etc. is provided. So these are kind of benefits which a startup gets. Then there is also a Startup India Seed Fund scheme. So over here, what has happened is, the government has a corpus of around 945 crores or so, which the government will give to certain priority sectors like education, agriculture, etc., where there are players who is having kind of a unique idea. They can make an equity investment, or they can give a loan, a seed fund or a startup fund, which can be given, for which your company should be a startup recognized, incorporated not more than 2 years ago, and the business idea is to develop product or service with the market fit. So here, for this Startup India Seed Fund scheme, you have already studied probably what is a startup, etc. But for you to be getting a grant under the Startup India Seed Fund scheme, sometimes in the Startup India Seed Fund scheme, they give you a grant, or sometimes they give you a loan of anywhere up to, I think, 20 lakh rupees in priority sectors. So over here, you will have up to 50 lakhs. So maybe around 20 to 50 lakhs can be given. This is maybe a grant given by the government, or sometimes a loan given by the government. And there are certain priority sectors for which this can be predominantly given. Okay. Now, there is some theory given on why India is becoming a sustainable environment for startups. So there are a few important pointers. The basic thing over here is the pool of talent that we have. A lot of talent that we have. You look at the biggest CEOs of the biggest companies, they are Indians. There was a lot of brain drain happening. India's ecosystem was not as evolved. Now you are in a very golden era, honestly, where we are in the best environment where we can stay in India. And unlock the best potential. In fact, expats are planning to come back to India. So the pool of talent that we have is really good. We are inherently very hardworking, very intellectual people. Cost effective, okay, that's a very good trade-off, at least for an entrepreneur, where there's excellent talent, but it is not as costly as probably the developed countries. Increasing use of internet, needless to say, after 2016, it's kind of a very important year, pre and post geo kind of a thing, where internet penetration in India has kind of gone to another level, which has taken our country to an all new dimension and explode. So you see UPIs everywhere. Without, let us say, good internet connection, do you think that it was ever going to happen? So now that is happening. The technology that we are developing in-house or kind of using, and a variety of funding options which are now available. Earlier it was only traditional banks, etc., which would not be as likely to fund a startup. Now with all the options, venture capital, angel investors, etc., there's a plethora of opportunities. So the ecosystem, this is what you call as the ecosystem, the talent, the cost, the internet connectivity, technology availability, capital availability, all of that is now developing very well, which kind of makes India one of the third biggest rather startup ecosystem outside US and China, US and China being the first and the second, and India is now the third. Okay, then there is another important area which I would say is succession planning, which is also a point where questions have been asked in the recent RTP and MTP. So what is succession planning? Well, usually a startup is in the shadow of the founder. However, as the startup grows, for various contingencies, maybe there is a problem, there should be a succession plan in place. So over here, succession plan is the process of identifying the critical positions within our organizations and developing action plans for individuals to assume those positions. So this is your succession planning to ensure that the organizational growth is kind of managed. You don't spend time when you are growing in kind of finding people. You kind of identify, groom the people beforehand. This is more so useful for a family owned business. It enables a transfer of ownership to rising employees. Over here it is for a family owned business. So why is there a need for succession planning? In few places we have kind of written these mnemonics. So there is CART. What is the need for succession planning? CART, cause removal. So if you have to remove someone for a particular cause because of gross negligence or fraud, etc., at least you have managers in place to take up that position. CART, aligning. Your thought process of the people has to align with that of the family or the founder. So alignment is a must, for which you have to groom the person. Or there is risk mitigation. Over here, if an existing leader quits, sometimes you might have to remove them, sometimes they quit. Then how do you plan the succession? Or T is the talent pipeline. You keep your employees motivated. When the employees see that the firm is kind of grooming them to take on a particular position, that results in great talent pipeline for your company. And a conflict resolution mechanism. So over here, if this is in place, at least the conflicts for a particular corner office may be managed in a slightly better way. So there are 5 things. CART, we say first. C would be cause removal or conflict resolution management. Second, A is alignment. R is risk mitigation if a leader quits, and T is the talent pipeline. So this is what you can possibly remember on why do you need a succession planning to be there. Business succession strategy. So this is divided into 4 steps. First, you identify the positions which need. So what are the key leadership positions for which you need to plan. Second, you look for the competencies inside those positions. So what does an ideal candidate need to have? What are the competencies do they need to have for this position? First, try to look within in your organization. Do you have that kind of talent? Like a talented article like you, can he assume leadership position, for example, within the organization only? Or if the organization itself does not have it, start a process to probably look for those competencies even outside of the organizations. So over here, maybe you get someone called as a bridge leader. Bridge leader is probably you want to groom someone. However, you don't want an outsider to run your company. Then you get as a bridge for some time a leader who grooms and trains your employees, kind of an advisory role. So that is a bridge leader. So steps: first, identify the positions. Second, identify the competencies that are needed for that position. Third, see if those competencies are there in-house internally. And fourth, if required, get a bridge leader in place. Challenges in case of succession planning: the founder's mindset is very different from the corporate mindset. So the way a founder thinks is very different from a corporate manager thinks. Premature for startups. Now we are growing. At this point, if I tell you now to make a will, आप बोलोगे सर will में डालेंगे क्या articleship stipend, but nevertheless if I tell you to make a will, we'll say we are now in the growing phase. Who will make a will now? Some people might make and do a lot of things, but we say yeah, we are now in the growing phase, we'll do it at a later stage. Premature for startups to implement succession when you are now focusing on growth and not necessarily on succession. Founders are the face of startups. So like Steve Jobs, Apple is no longer a startup, but the way it is reinventing it is phenomenal. But Steve Jobs was the face of it. So this is the face of kind of a startup, which is the founder. So these are the challenges that can come in the form of succession planning. So this is regarding startup finance. I would say this is slightly important. Mergers, I mean, we're just doing it in line, so I'm just finishing. There's just one small value. There's something called as unlocking of value. How do mergers, acquisition or business combinations unlock value? Not very important. Kind of they, in a horizontal merger, they kind of help you in diversifying. In a vertical merger, it helps you in better cost efficiency. In kind of a conglomerate merger, it can put your resources in a much more productive usage. It can help you in increasing the cash flow. All of these are regarding mergers. Then over here, this is regarding a restructuring, business reorganization, like a amalgamation or like a holding and subsidiary coming together. This will help in much more streamlining, better streamlining and processes. So over here can possibly make you more competitive. You can nourish a sick unit within the group by kind of putting it inside a overall company which has a much more stronger balance sheet, etc. So you can just broadly go through it. I would not really put a lot of importance behind this, though unicorn is something which I would put a lot of importance, and even pray that you build up a unicorn. And succession planning is something which is also something which is important. Okay, so then you go to another important area. So this is regarding I mean, interest rate management. It is not really important. There is something called as a benchmark rate. What are benchmark rates? They are also called as reference rates. Reference rates were typically something like LIBOR, London Interbank Offer Rate. However, LIBOR got rigged, unfortunately, and it was detected, and the world generally decided that you want to move out of LIBOR, which is an interbank offer rate. Like, it is just a rate which is not an actual rate on actual lending or borrowing. It is just a compilation of rates that bankers would have possibly charged. So this, you are going from interbank rates to probably much more overnight index rates. So alternative reference rates, ARRs, are being developed. So in US there is something called as SOFR. In UK there is something called as SONIA. So these are few rates that are mentioned. We have kind of highlighted that. So these are basically reference rates, which was earlier LIBOR and is now different rates for different countries. So you have USA, the sterling, secured overnight financing rate, sterling overnight index average rate. You have Ester in Europe, Tonar in Japan. So these are just kind of various rates. Important is SOFR and SONIA, which are much more popular today. In India, locally back, you currently have rates like RBI repo rate, base rate, prime lending rate, etc., which can be used as reference rates. Other than that, in India also earlier you have, and still you have MIBOR, which is in the process of being phased off, and MIBID. There is MIBOR, which is Mumbai Interbank Offer Rate, and MIBID, that is a Mumbai Interbank Bid Rate, like the bid and ask like you do. So the Mumbai Interbank Offer Rate and the bid is another rate. So we have given some theory over here, which these are rates which are used for pricing complex derivatives, for kind of pricing swaps, etc., has a base reference rates, which are now moving to alternative reference rates, which are called as benchmark rates. So this is some theory on what is a benchmark rate in interest rate management, which has been added. Okay, next there is International Financial Center. I would put this as important because of so much buzz which is coming around the gift city. So first of all, what is an International Financial Center? It is kind of a center which is in, let us say, a particular country like India. However, you have some favorable regulations, much more relaxed. It is, for all practical purposes, treated as if you are operating outside of the Indian jurisdiction, whereby the Indian laws will not necessarily apply. However, you have much more favorable, relaxed laws. So over here, that is the International Financial Center. In India, Gift City is one of the international financial centers which the government is kind of putting a lot of emphasis on. Why do you want to make international financial centers in India? Well, to kind of retain talent. Remember, so over here, if we just go one by one, so over here, International Finance Center caters to needs of customers outside their own jurisdictions. Earlier, Singapore, Hong Kong, etc., Dubai were international finance centers. A lot of global funds would set up their offices there to manage. Let's say Singapore is used to manage the entire Southeast Asia. Dubai is used to manage Middle East. We want India to use for managing South Asian operations of a lot of global funds. So we want to set up infrastructure which is really high end, if you see the Gift City, etc., so that international highly paid talented professionals can kind of stay over there. Indian people who are going outside, the brain drain that was happening will probably not happen. And again, innovative financial products like the complex derivatives, etc., which were earlier not as prevalent in India, can also be developed because these international institutions come over here. So over here, you have a different set of regulations and laws. Flexibility is given. FEMA, for example, does not directly and as draconian a law, it does not apply as strongly over there in the GIFT. So benefits, it's an opportunity for qualified professionals, especially finance professionals like you. A platform for talented professionals to pursue opportunities, brain drain. So this is probably to retain our talent and to rather get good talent in our country like US. Get such good talent, so many of our good engineers go over there. Imagine if they are in India. Finance professionals, imagine if they are in India, how good will our country grow. Bringing back financial services transactions which are presently carried out abroad because we don't have the ecosystem. We want to develop that ecosystem, and trading of complicated products also to be done. So this is the benefits of an IFC. The constituents of IFC, there has to be really A-grade infrastructure. A stable political environment is a must, otherwise international talent will not come. Strategic location, it has to be close to the airport, port, has to have good weather. Quality of life, this is a very general thing. It should offer a good quality life, maybe it's good infrastructure, etc. Rational regulatory framework, relax if you keep very strict laws over there. What is the point of setting up a center? And sustainable economy. So these are constituents. We have mentioned this as QR pile over here. Q is quality of life. R is rational regulatory framework. P over here is stable political environment. I over here is infrastructure which has to be highly developed. L over here is the strategic location, L for location, and E is the sustainable economy over here. So you can just refer this, and probably important, have a note for the Gift City. So first you understand what is an international financial center. It is kind of a favorable jurisdiction where we have favorable tax laws, overall regulatory laws. What are the benefits? Probably helping retain our talent and getting also really good international talent back to our country. And you will have let us say complex financial products being traded on our platforms. A prerequisite for that would be good infrastructure, good quality life, rational regulatory environment, stable political environment, high quality infrastructure, strategic location, and sustainable economy. Okay, Gift City. A lot of talk around this. Was set up in 2007. The main objective was to retain financial services which moves out of India. We treat this as a separate jurisdiction, has a relaxed tax laws. The budget has given a lot of relaxations over here. Exchanges set up by the NSE and BSE over there. A lot of global players also coming. So there's a competitive tax regime at the Gift SEZ. So Gift provides very competitive cost of operations, competitive tax regime, single window clearance, relaxed company law provisions, international arbitration, overall facilitation. FEMA is also not applicable. So these are a few things. Exchanges of the BSE, NSE have been kind of put over there. So these are a few things that you can compile to write a 3 or a 4 mark question. Then you have something called as sovereign funds. What are sovereign funds? Funds like GIC, Temasek of Singapore, or the Norwegian fund, which is the biggest fund internationally. Who's deploying funds, Canadian pension fund, etc. These are sovereign funds. These are funds which are maintained, managed by the respective governments. Now, if most of these developed countries, if they have surplus funds which they could deploy to meet certain objectives, these surplus funds may be due to surplus tax collections, disinvestment, privatization, etc. This can be used to kind of deploy and generate a much more higher return and beneficial return. So these are state-owned funds like Mubadala of Abu Dhabi, the biggest fund, Norwegian fund, Canadian pension fund, Temasek of Singapore. These are huge funds which are surplus funds. That these are state-owned funds, comprised of money generated by the government. Money is generally derived from the country's own surplus reserves. Why are we doing this? The sources are surplus reserves, bank reserves, certain foreign currency operations, privatizations, etc. These are the sources, not very important. Generally, why are they created? To achieve a targeted purpose. Maybe they want to focus on sustainable energy. Maybe they want to focus on certain education and upliftment of the population. So maybe these are various objectives: to diversify, earn a better return, assist monetary authorities, provide stabilization of budgets, etc., increase savings for future generation, etc. So there are various things. To fund social and economic development, like develop the education, invest in such things, ensuring sustainable long-term growth, political strategies, if you want to kind of, like China uses that for a lot of other objectives as well. Sovereign funds have their own objectives, risk tolerance, terms and other liquidity considerations. There are various types of classification like stabilization funds, savings or future generation funds, public benefit pension funds, reserve investment funds, strategic development funds, etc. So sovereign wealth funds. So just go through it. Basically the keywords over here are, these are state-owned funds set up by surpluses that are generated, generally used for achieving certain targeted objectives, and a few types of funds you can just mention as a pension fund or the state-owned enterprise funds, etc. You can just mention over here. Okay, so this takes care of international financial management. Next, you have foreign exchange. A couple of things over here, specifically a note given regarding SWIFT. So if there is a short note which comes regarding SWIFT. What is SWIFT? It is basically Society for Worldwide Interbank Financial Telecommunication. You must have seen a lot of international remittances happening using what we call as SWIFT. So SWIFT is not a settlement system like RBI's clearing house, etc. They have a settlement system. SWIFT is just a messaging platform. It is a messaging platform, I think, which is based on Brussels or in Belgium somewhere. So it is a messaging platform where all the registered foreign exchange participants would kind of, if they want to do an international remittance, let us say in India, RBI has a platform whereby money can be transferred anywhere between Indian accounts. But if I want to transfer from an Indian account, let us say to a US account, there is RBI and there is a Federal Reserve. I mean, they have two different systems, and hence I have a SWIFT messaging system where an Indian bank will message on the SWIFT system that it wants to remit money, and there will be a US bank on that SWIFT system to which that money is going to be remitted. So it is more of a messaging or a telecommunications system which ensures efficient communication between the participants for remittance of money. So over here, role of SWIFT: uses a network of communication to carry out business transaction. You can remember the full form of SWIFT, and it is purely a messaging system. It is not a settlement system. We say that is not a settlement system. Under the SWIFT system, codes have been given for each country and its currency. Like India has INR, like US has USD, Britain has GBP, etc. These are the codes under the SWIFT system. Okay, so over here, SWIFT plays an important role in foreign exchange because it provides quick settlement, as messaging can take just a few seconds. Security and reliability: there's a centralized system where it is of very high security. Can reduce cost for banks to kind of communicate with the banks overseas. You can easily do using the SWIFT system. It reduces the overall cost, brings in operational efficiency. There's full backup which is maintained. It acts as a catalyst which brings the agencies to work in a much more better manner. So this is just general discussion regarding the SWIFT system. Then we have national and international payment gateways. Payment gateways can be someone like a GPay, someone like even a Razorpay, etc. These are payment gateways which help in a transaction. So basically this acts as an encrypted medium between the person who is paying and the point of sale, that is the person who is receiving. The person who is paying is giving his debit card details, his bank details. So he wants the system to be very secure. Again, the person who is delivering the product or the service wants the money to come into their account. And as a result, both of them want an intermediary in the middle who can get this financial data in an encrypted, secured manner, get it validated from the bank. So if I am saying that I am buying paying 10,000 rupees, are there 10,000 rupees in my account? So you get it validated from the bank. The bank will debit that 10,000 from my account. That communication will be given, for example, to the point of sale, that is a seller. So this is what a payment gateway does. There are payment gateways which are Indian payment gateways, like this Razorpay, etc. There can also be international payment gateways, someone like a PayPal, for example. These are international payment gateways. Also, a lot of times these are used by international websites like booking.com, etc. or makemytrip.com, so that the pricing gets denominated in India's. So like a buyer is much more comfortable buying if the products are denominated in the buyer's price. The moment you see dollars, you get a little taken aback. You say, no, I want to buy in my own price. There's a element of familiarity, and hence there are international payment gateways which kind of convert this and showcase it to the reader that they are paying, and they will actually pay in rupees only, not in dollars. And thereby the transaction gets processed at the back end from rupees to dollars, and the point of sale, the seller who's, let us say you're traveling to US and you are buying or you are kind of staying in a hotel, you want to pay in rupees. The hotel property owner wants a payment in dollars, so there's an international payment gateway who will collect money from you in rupees and remit that in dollars. Maybe booking.com uses that, and they have to pay some commission to this payment gateway. So basically, what is a payment gateway? A few keywords would be an encrypted medium. It kinds of acts as an intermediary or a bridge between the buyer and the point of sale seller. It provides a encrypted interface whereby you can get the validation from the bank and provide a reliable, trustworthy framework where the monetary transactions can go through. A payment gateway is a virtual mode of equivalent to physical mode of transfer of cash that authenticates and routes payment details in an extremely secure environment. So payment gateway ensures an encrypted channel which securely passes the transaction details from the buyer's personal computer to the bank's authorization approval. The transfer of data happens in the encrypted manner, and after the approval from the banker, completes the transaction along with verification. So this is an important few things. If you can recollect and reproduce, that will be perfect. A payment gateway provides multiple benefits like convenience, authorization, reliability, etc. But still, payment gateways have some so there is a lot of things which are mentioned over here. Multiple payment options can be provided. It minimizes the risk. It is flexible. Can ensure refund if transaction does not go through. Simple. Provides multiple interfaces, etc. You can just quickly go through it. There are some challenges, because if the customer does not have a bank account, then to kind of make a payment through a payment gateway may not be possible. There may be limited banks which are hosted on the platform. There may be a general lack of trust among customers, and hence they may be reluctant to kind of participate on the platform, etc. There are also some international payment gateways, as we discussed, which can help in international transactions. Okay, so this is regarding payment gateways. Exchange rate determination. You usually, the most important factors in exchange rate determination, as we say, is inflation and interest rate, for which you study inflation and interest rate parity theories. But other factors which also impact the exchange rate, for which there is no model that you are taught, as we discussed even in foreign exchange, can include things like fiscal or current account deficit. The general rule is, if you have a surplus, just a second, sorry, if you have a surplus that is favorable for your currency will strengthen, but if you have a deficit, your currency will weaken in the current account. In a similar way, if there is a capital account, if there's a net inflow, your currency will strengthen, but if there's a net outflow, your currency will weaken. So this might come in MCQs on what will be the impact if there's a current account deficit or surplus, etc. Then there are trade barriers, like if you have import barriers, then importers cannot use and pay, in which case there may be a positive impact on your currency, because if there's an import barrier, you're not allowed to import, let us say, from China, then these importers in our country will not really buy foreign exchange, and hence our currency will rather strengthen. Intervention by banks. Sometimes currencies may slide, and hence RBI might buy and sell in huge quantity. That might impact the exchange rates. Government controls. an expectation. There's something called as a bandwagon effect. So in certain countries, there are certain speculators, like Harshad Mehta was a big, I would not really call a speculator, but let us say Harshad Mehta was a big name, and you have Scam 92 playing in your background. So over here, when you look at Harshad Mehta, if he was probably going short a particular script, the market in general might go short or long on that script. He was a bull. In a similar way, over here, there may be in exchange rate, like we say, your demand supply exchange rates can change due to inflation and interest rate, of course. Apart from that, fiscal and current account deficits, etc. Your trade barriers may be important. Government may put control. RBI may act in a similar way. Instead of RBI, there may be a big speculator. Then if a big speculator is taking a particular position, your currency might also shift in that position. Though in today's environment, in countries like India, etc., it's very difficult for a particular speculator to kind of move the needle. It's very difficult even for a central bank to do that, so let alone a speculator. So but that is called as a bandwagon effect. That is, if one person does, the herd follows behind that. Okay, next you have something called as economic exposure. If you are operating, let us say, in a foreign exchange market, when you are operating in a foreign exchange market, you are exposed to foreign exchange risks for which you need some protection against volatility. This hedging will help you in getting cost reduction. It will give you a competitive advantage and improve your cash flows. If you are if you are the type of person who is able to manage your exchange rate properly, there will be an improved cash flows. There will be a competitive advantage. There will be compliance with regulations. So over here, the importance of foreign exchange risk management. Why is foreign exchange risk management so important? Because it helps in protecting volatility, reduces the cost, gives us a competitive advantage as compared to people who are still kind of battling that uncertainty, etc. Hedging risks, various methods like forward futures, options, money markets can be used, but otherwise certain traditional methods or other methods like what was written over here, I forgot the name, pre-shipment credit. So you take a loan in the foreign currency, for example, or a loan in FCNR, foreign currency non-resident account. These might be used for the purpose of protection as well in foreign currency. Let us see. So not something which I would say is anything significantly important when it comes to foreign exchange. In derivatives, definitely there are a lot of new topics. We have a separate video also for the same, but nevertheless we'll do a quick discussion regarding the theory topics of the 3 practical sums for derivatives, the real options. There's a separate video along with the derivatives comprehensive video that I've uploaded. Along with that, at the end, no, not at the end, a separate video I've put for real options, so you can refer those numericals over there rather than discussing it over here. These are numericals from the institute material, and hence it is imperative you do it okay, so separately. So if you want, I'll share the link for that separately as well for the real options, 3 questions in the study material. Okay, now in derivatives, there are 4 things which are new on the theory side. One, there is something called as an exotic option. Second, there is something called as a credit derivative. Third, there is something called as a weather derivative. And fourth, there is something called as electricity derivative. Weather and electricity derivative I would not really say are as important, but otherwise these exotic derivatives, at least from an MCQ standpoint, can be possibly a lot more important. So first we look at exotic options. What do you mean by exotic options? Well, typically we have studied call options, that is a right to buy, put options, that is a right to sell. Then European option, that is options that can be exercised at the expiry. They can be bought and sold before, but they can be exercised at expiry. Or American options, which can be exercised at or even before their expiry. So these are various types of options. However, what do you mean by exotic options? Well, there are certain additional features. These are not same as your simple, also called as plain vanilla options. These exotic features can result in various different types of options, which you should be broadly aware. Remember, these options are not usually traded on the exchanges. They are over the counter, that is 1-to-1, and they will not be traded. They are more complex and they will be traded in the OTC market. So first, quickly we'll discuss. One is chooser options, where you get a choice of deciding at a later date whether this option will be a call or whether it will be a put. Second is a compound option, something like an option on an option. So you are having an option to decide whether you want to ultimately have an option or not. So that is an option on an option. Barrier options, these are options that will be triggered only if a specific level is crossed. Otherwise they will not be triggered. So a particular price level, etc., only after that will they get triggered. Binary option, that is an event specific thing. So if, let us say, a war happens, then this, or if it does not happen, then this. So it is like a binary event, not based on price fluctuations per se. Fixed payoff if an event happens or it does not happen. Now Asian options, you have studied European and American, so why should we be left behind? So Asian options will look at average prices. Like American options or European options are based on a particular price as on a particular date of expiry, or when you exercise. In Asian options, you will take the average price. So over here, this is the average of the prices. Then you look at Bermuda options, where it is kind of a mixture between European and American, where American can be exercised at any date, European can be exercised only at maturity. Bermuda option will be exercised, let us say, at specified dates, not every day, but not necessarily at maturity as well. So if it's a 5-month option, let us say at every month end, you are getting an option to exercise if you want to. That is called as a Bermuda option. Then you have a basket option, where the underlying, instead of it being a single item, is kind of a basket of items. Spread option, where the payoff is based on the differences, that is spread, rather than the price per se. And then there is a look back option, where you can look back and decide which is your most favorable price that you want to select. So this is called as a look back option. So these are various exotic options, important from an MCQ standpoint. Credit derivative. Now usually all the derivatives that you have studied are mostly financial. So they are helping you hedge what we call as a financial risk, that is a risk of the price changing. However, what if the cash flow that you are expecting to receive itself will not be received? So this is called as a credit risk. What if that cash flow itself is not going to be received? In which case, well, the derivatives which are used for hedging are called as credit derivatives. Now credit derivatives are usually, now it is over here. So this is to mitigate the credit risk, that is a counterparty, or also called as a default risk. First, there is something called as a collateralized debt obligation, or a CDO, which is also kind of in a way covered when we do securitization. And second is credit default swap. So more important in my opinion is a credit default swap, where you can, which is much more popular and for which a simple note can also be asked. So what happens in case of a CDS? In case of a CDS, let us say I have purchased a bond of, let us say, Indigo Airlines, or I have purchased a bond of, let us say, SpiceJet. So I am kind of the investor and SpiceJet is the issuer. Now SpiceJet has to pay me money over the next 10 years. Now I am worried that the way airlines are going, I am worried that probably SpiceJet may not pay me the entire money. But I've purchased the bond, I'm stuck with the bond. So I want some insurance. So if someone is ready to give me an insurance that if SpiceJet defaults, the 100 rupees that I had to receive from SpiceJet, if SpiceJet does not pay, it pays me only 20, then the remaining 80 will be paid by someone. So I want that insurance that is given by a CDS seller. So in a CDS, there are two parties. There is a buyer who is typically a bondholder who is worried, and there is kind of a seller who is kind of confident that SpiceJet will pay money, and hence seller is kind of agreeing to compensate for the shortfall if SpiceJet does not pay. Now one can question that why will a seller even do this? Well, because the seller gets premium. The buyer of the CDS will have to pay premium, the seller will receive the premium, and the quantum of premium will be decided based on the credit risk at that prevailing point of time. So if the credit risk increases, the premium will keep on increasing. Now when you look at CDS, there are three parties. One is the original borrower, that is SpiceJet. One is kind of the investor, let us say, who is buying this bond, and one is, let us say, the person who is selling the CDS to the person who is buying the CDS for a premium. So over here, the credit default swap provides insurance against the risk of a possible default on a debt. That is what a CDS does. If the default takes place, settlement, there will be settlement. In case no default takes place, there will be no cash flow. The income for the seller will be the premium amount. The features of CDS, remember, this is mostly an over-the-counter product. It is not a tradable product. It is a non-standardized, it is not traded. There is usually International Swap and Derivatives Association, which has, like FEDA is there for foreign exchange. Over here, they have provided guidelines for the CDS. It can be purchased from a third party to protect. Individual borrower who is buying a bond from a company can purchase CDS to protect his investment. The premium will have a positive relationship with the risk. Higher the risk, higher will be the premium, as we discussed. And there is a term called as naked CDS. What do you mean by naked CDS? That is, this is a CDS held by a person. I'm buying the CDS as a speculator. I don't hold the bond. It is not for hedging purpose. I think that this guy SpiceJet will default. I don't want to invest in SpiceJet, but I'm ready to pay a premium, and if they default, I think that I'll make a profit. So that is, I'm buying what I call as a naked CDS without having that underlying bond with me. Okay, The uses of credit default swap, main uses for hedging, for protection, can also be for arbitrage or for speculation. Like in naked CDS, there is a speculation. The parties to a CDS, as we said, is the initial borrower like SpiceJet, the person who is the holder of the bond, and a seller who is writing or giving or selling the CDS. Settlement of CDS can happen on a physical basis or on a cash basis. If it happens on a physical basis, it is the holder of the bond will give the actual bond to the CDS holder, and the CDS holder will give the par value. So I will give my bond and they will give me 100 rupees, which was a par value, which was agreed to be paid. In case of a cash settlement or a net settlement, I will not give them the bond. However, the difference between what SpiceJet is willing to pay me, that is 20, as compared to what the par value was, 100, that is 80 rupees, is what they have to pay me. So this is regarding CDS. I would kind of expect a possible question on CDS, which is relatively more important. Then we have something called as collateralized debt obligations. Now these are like pass-through certificates or some asset-backed securities which you did in securitization. It's a little complex, so you have a broad understanding and proceed over here. So this is collateralized bond obligations, collateralized loan obligations. There are types of CDOs, which is cash flow or synthetic or arbitrage CDOs. So when you look at a cash flow based obligation over here, it is backed by cash market debt or securities. In a synthetic, there is no actual necessary same security. It is transferred to an SPV, and synthetic CDO is structured in such a manner that credit risk is transferred to the originator without actual transfer of assets. So in this case, without actual transfer of assets, it is structured. And then is arbitrage speed CDO, which is to capture the spread from the collateral versus the cost of borrowing. The risks involved in CDO, as we say, default risk can be there, interest rate risk, liquidity risk, prepayment risk. These are same risks which are there in case of a bond. Possibility of a default, possibility that interest rate changes, possibility that there is no trading at least in these instruments, so there is a liquidity risk. Prepayment, money may come early. That money which comes early, I'll have to deploy it somewhere, maybe at a lower rate, reinvestment risk. And then foreign exchange in case of foreign exchange items. So this is similar to that of the risks of a bond. Okay, next you have weather derivatives. Now weather derivatives are for let us say farmers, etc., whose business is greatly impacted by, let us say, the weather, like rainfall, temperature, etc. Now someone can say that we already have insurance for that, but insurance kind of protects you against what we call as those black swan big events like earthquakes, floods, etc. If there is a lesser rainfall, your crops might not grow as well, you might not have the best of the produce. That is not what an insurance company is going to protect you against, and for that you have a weather derivative. Weather derivative, an important term for you to remember, is a weather derivative is going to protect you against what you call as volumetric risk and not price risk. So over here, if on an average at a normal rainfall you would have 10,000 tons and you are now having 8,000 tons, which is attributable to lower rainfall, to protect against that volumetric risk, there will be weather derivatives. There are a lot of challenges when it comes to weather derivatives because the underlying over here is weather, and how to reliably quantify the weather, kind of figure out the fluctuations, look at reliable sources of data, you look at predictions, like you look at our meteorological department. Sometimes now things are kind of improving greatly, but just on a lighter note, whenever, at least in Mumbai, there is a prediction of a heavy rainfall, there's almost always a sunshine which is there. So the prediction again is a bit of a problem, and hence there are a lot of challenges. So when you look at weather derivatives, the underlying over here is weather, which is used for the protection of volumetric risk as compared to the price risk. Primary objective of the weather derivatives is to hedge the volume risk rather than the price risk, as we have discussed. Insurance provides protection against extreme low probability events, whereas weather derivatives can kind of provide protection against your regular losses which might arise due to probably lesser rainfall or maybe a higher temperature, let us say. The seller will provide a monthly amount in case the buyer suffers any financial loss due to adverse weather conditions and not necessarily floods and earthquakes. The problem over here is the data, forecasting of weather, temperature modeling, all of this, it is still in a very nascent stage, and hence these are possible challenges. Next we have electricity derivatives, major participant being electricity distribution companies, generators, power utility companies and users. Electricity in our country is, the prices are a lot volatile, and hence companies like steel companies, etc., which need a lot of power and who are probably buying this power, they need an assured pricing for this power, so they might enter into electricity derivatives. The derivatives over here is the same. as your currency, equity or bond derivatives, just that the underlying over here is electricity. This is again a price, same as the financial risk. So you are not having a volumetric risk over here, it is a price risk that you want to hedge the movement in electricity prices. There can be electricity forwards, electricity option, electricity futures. There can also be electricity swaps. There is also a special feature of a swap called as electricity locational basis swap, where you are looking at the differences in electricity prices, the basis between the spot price and the futures price for which you enter into a swap. That is also one of the products over here. A small note for that. Real options, we have discussed this separately, but a quick reference. Real options are options on capital budgeting projects. In these options, you kind of have the underlying as a project and not a financial instrument. Usually they are typically a lot more long term in nature as compared to a pure financial derivative, which is relatively a lot more short term in nature. It is intended to supplement and not replace the capital budgeting analysis which is using cash flow. So there can be a long call, which is like a growth option or a timing option, where you want a right to buy a project but maybe not immediately, you want some time. That is a long call. A long put is like an abandonment option, where you want a right to sell in case the project is not doing well. So that is kind of a long call. A person who is giving that call or giving that put, there will be short call or short put, as the case may be. So as we have discussed over here, there are three options: growth options, abandonment options, timing options. Growth options are options where your project might currently have a negative NPV. However, going forward, we expect a lot of growth, and hence you might want to be a part of that project. It is usually similar to a European call option. And timing option is also a call option, where you want to not enter probably now, you might want to enter at a future date as well, entering a project. So that is buying a project. So this is like a call option, an American call option at the timing that you want. Abandonment option is the exact opposite, where you have taken a project, but usually capital budgeting projects are irreversible projects. So you are kind of hesitant on whether you want to do or not. So someone is giving you that option that if you want to abandon midway, you can abandon and give the project to someone and they will pay you a predetermined price. So that is an abandonment option, which if you are holding, this is like a long put. So growth options, abandonment options, timing options, these are real options which are there in derivatives. Okay, so that kind of takes care of the discussion regarding derivatives. Next, you go to mutual funds. In the section of mutual funds, you have some discussion regarding the evaluation of mutual funds. This is pure theory. I don't see there is a section coming from this directly. Evaluation, what do you see in evaluation? Why do you need to do evaluation? Well, you are investing in a fund, yes, but then you need to constantly evaluate whether the fund is doing well or not, whether it is performing well as compared to its peers, as compared to the benchmark return, as compared to what you were expecting, etc. So ideally, performance evaluation should be done every 6 to 12 months. There are two types of parameters. One, there is something called as a quantitative parameter, and then there is something called as a qualitative parameter. So when you are doing quantitative parameters, there is something called as risk adjusted returns. So some returns, like you look at a Sharpe ratio, Trenner ratio. So you are looking at risk adjusted returns, where you are looking at like a Sharpe ratio will look at RF minus your return minus risk free rate upon the standard deviation. Trenner will take the beta. There's also a new term which I think I have seen in the November 23 paper or somewhere, I don't know, called as a Sortino ratio or something. I think we have included here, I'm not sure, but yes, you have this Sortino ratio, financial measures that you say Sortino ratio. It is a variation of Sharpe ratio only, just that in the numerator you take Rx minus Rf divided by, instead of taking the total standard deviation, you take the downside standard deviation. That like you have the downside risk, what is the downside standard deviation? The question should tell you that, and you will take only that. So the downside deviation will be taken instead of the total standard deviation in the Sortino ratio. So if that comes in the exam, you will take the same formula, return minus the risk free rate upon the downside standard deviation, which has to be given to in the question. So other evaluation ratios are Trenner ratio, Sharpe ratio that you have done. Also an expense ratio, where you try to find the expenses percentage. The lower the expense ratio, the better it is. The higher the Sharpe, Trenner and Sortino ratio, the better it is. Other than that, you look at risk adjusted returns can also be something like the Jensen's alpha, where you are trying to find the return adjusted for the risk. So the Jensen's alpha is also a parameter. Benchmark returns, you identify a benchmark like the Nifty, or if you are a bank fund, then the bank Nifty, etc., and see how you are performing as compared to that benchmark. Comparison to peers. Well, remember, you are an investor, you have invested in a fund. If other peers are doing much better, then probably you should question the fund that what is the problem here, or why should you not shift to the other peers. Comparison across different economic and market cycles. When you do the comparison, it is not just comparison to be done at a particular point. How has the performance happened across cycles, like in an up move, down move, recession, etc. Okay, and the financial measures, which in my opinion are the more important ones when you write the theory. Qualitative parameters. Over here we have just focused on the numbers, like how have you performed as compared to the Sensex, that is a benchmark. How have you compared as compared to your peers? How were your risk adjusted returns, like the Jensen's alpha? How was your tenor ratio, Sharpe ratio, Sortino ratio, etc. But the qualitative factors, like the fund manager himself, the quality of the portfolio that they have, the team, and the processes, the compliances that they do are also equally important. So over here you look at the quality of portfolio, whether they are investing in highly risky speculative companies or stable companies with good financials, track record of this fund manager, credibility of the team beyond the fund manager as well. The role of fund manager in mutual fund. Now, usually the fund manager's role is to invest in such a way that the return is maximized at the least possible risk. So that is the core role. But is that the only role? Well, there are two types of fund managers. One is an actively managed fund where you try to do stock picking. You try to pick up stocks which you think will give you a higher return. So you try to do stock picking, whereas there is a passive fund manager which will just track the index. So they will have an index and manage your portfolio in a way that it is tracking the index. So over here, the other responsibilities of a fund manager can include compliance with so much compliance needed by SEBI, etc. Compliance has to be done, proper reporting should be provided on time, constant monitoring of performance. So over here you will just try to monitor whether everything is happening as planned, there's no fraud, etc. happening. Creation of wealth and protection, control over the works outsourced to third parties. Maybe some valuations or works may be outsourced to a third party. Whether that is done properly or not is also within the fund manager's domain. So in case additional roles beyond maximizing of return and etc. is asked, then you can mention these 3-4 things: ensuring compliance, seeing that the work outsourced to third parties is done properly, constant monitoring, and creation of wealth as well as the protection. The role of FIIs in mutual fund. FIIs is a foreign institutional investor. Typically these are set up outside India for investment, let us say in India. Usually they invest directly. Now a lot of these FIIs also invest in mutual funds. So when FIIs usually bring in a lot of money, and hence there is a lot of liquidity which these mutual funds can have for the purpose of investment. So over here for FIIs, if they come in a mutual fund, it will ensure that you have enhanced corporate governance, because you will try to ensure that your funds don't have any corporate governance lapses, otherwise they will not come. Improved competition in the market for this money and improved inflow of capital in our economy. This is general mutual funds. I would only kind of from an exam perspective look at this Sortino ratio just in case we should know, but otherwise there's nothing much per se. Okay, next you look at securitization. Again, this is an important chapter, and within this chapter, two terminologies: one regarding blockchain, which is also done in your financial reporting in accounting and technology, and second is tokenization. So if something comes, probably my sense is it will come in one of these two things. But otherwise, they've also added a section for discussing the risks in case of securitization. So the risks in securitization, there is a credit risk or a counterparty risk where the parties don't really pay money, default risk. Legal risk, because in a country like ours where securitization is relatively new, SARFAESI Act is there's not enough legal precedence, and hence who is the legal owner, etc. There can be a lot of conflicts. Market risk, there are three market risks. One is macroeconomic risk, one is prepayment risk, and third is interest rate risk. These are similar to a bond instrument. Again, when we did CDOs, we kind of discussed these risks. Like a prepayment risk is a possibility that the money may come in early and you might have to reinvest at a relatively lesser rate. Interest rate risk, market rates of interest might change, and in a floating rate instrument that can impact you. And a macroeconomic risk is a general risk, like the industry movements, downfalls, etc. might affect the overall securitization product. Now this is standard, I would say. In bonds this is a risk, in CDO this is a risk, in a securitization instrument this is a risk. So this is general. I would not really read a lot behind this point. One, the risks we'll just kind of have a broad understanding and proceed. The credit risk, the market risk, legal risk, etc. Then there is blockchain. I would say this is important. There has been a note that has been asked in one of the RTPs or the MTPs for May 24, and I'm pretty sure that you will get a question either in your financial reporting or your AFM, at least for blockchain, on a small question, because that is kind of a buzzword that the institute wants to possibly test you with. So when you look at blockchain, what is blockchain? A few keywords that you should be aware. We are not doing an IT class over here, but blockchain is nothing but a distributed ledger system. So over here, there is a distributed system of blocks. Blocks are like transactions, and a chain of these blocks, one after the other, forms a irreversible trail of transaction which cannot be reversed, and this is decentralized. So this can be open, this can be easily verified and viewed. So a few keywords that you need to remember for blockchain would be that this is a distributed ledger system. It has transactions which are posted in an irreversible manner. This will ensure that you can go back and trace those transactions and see these transactions, and no one can actually delete them. If you want to modify or edit this transaction, it will be treated as if there is a new transaction that is done. So the trail is so clean that you don't need a centralized third party to kind of register, verify that. Like when you look at property documents, you need to get it registered, so that if someone at a later date wants to see whether this transaction, so you have that on the registrar. However, if this happens on a blockchain medium, that trail of transaction is so clearly seen that you don't need to separately need these intermediaries like the registrars in case of financial transactions, even banks, etc., to validate that the transaction, because everyone, it is so decentralized, so everyone can access that, provided they have access rights and those keys, etc. So this is a blockchain, refers to as distributed ledger technology. It is a shared peer-to-peer decentralized. So distributed ledger, important word, decentralized, important word, with no third parties in the middle. These will result in permanent transactions, which is append only database. So that is add only, you cannot edit, cannot be changed or altered. It is fully irreversible, and change in the transaction is recorded as a new transaction. These are the few things regarding blockchain. What is a blockchain? Basically, it is a chain of blocks representing a digital information stored in a public database, which is called as a chain. So what happens in case of a blockchain? Basically, in terms of a transaction flow, a transaction is initiated. Once a transaction is initiated, it is broadcasted across a network. Because it is decentralized, not one party like Google or Facebook will verify. This will be verified across a wide range. There's something called as a consensus mechanism over there. You can Google up and try to watch videos for blockchain if you want additional knowledge, but at this stage probably you have better things to do. So it is broadcasted via the network. The network validates using cryptography. So there is some encrypted some protocols through which it gets, this is called as consensus mechanism. The transaction, once it is validated by this widely distributed network, it will be treated as a valid transaction and added to the block. The block is once added and the transaction is complete, and this is an irreversible block which gets added. Okay, the applications of blockchain, we have, I mean, there are a lot of applications. You would have even done this in FR, in accounting and technology. At least from your AFM standpoint, you can also have some other applications. There is Get FAH. So what is Get? G is application to the government. E is your economic forecast, it will help. T is the travel industry, and you have FH, which is financial service. In my opinion, the major application of this blockchain, at least the proof of concept, has been done by Bitcoin. Bitcoin is based on the blockchain technology. So when you look at Bitcoin, so over here, that is an application in the financial services industry, for example. So over here, you can have an automated trading life cycle. There will be a transaction log, and you will not need financial intermediaries, for example, for this. Second is healthcare. You will have probably a chain of transactions for a particular healthcare, a patient, etc., which can be a much more efficient way to manage. When you look at government, again, a lot of decentralization, a lot of paperwork and filings now may not be needed if it is properly put on blockchain. Travel industry, for passport or other identification, you can use this network. makes it like you have the DigiLocker. If you have used, it's not essentially blockchain, but when you look at the DigiLocker, it is now almost always, or at least in India, used as a valid identification proof. Economic forecast, you can use this decentralized data for making economic forecasts. So basically it will have applications in government, it will have applications in making economic forecast, for travel industry, for healthcare industry, financial services, and so many other industries as well. Okay, the risk associated with blockchain, again, it needs a lot of computing power. It is all based on this decentralized thing, where this decentralized group of people are validating, but who, if that consensus mechanism gets tampered with, how will that be managed? So all of this, so if there is the underlying consensus mechanism gets tampered with, then what do we do? There's no central authority, so having accountability is difficult over here. If there's a conflict, where will I go to resolve that conflict? And there can be a lot of transactions. If they put in, there can be information overload, in which case probably it may take a lot of time. So these are the few things where there is risks associated with blockchain. Then you have tokenization. Tokenization means converting of illiquid items into small tokens, which are liquid items which can be traded. In the last year or so, there was this thing called as NFT, non-fungible token, you might have heard, where there might be some illiquid items like paintings or some images, etc., for which there is a token which is generated, and that token is kind of on the blockchain, which can probably be sold, transferred to someone, where people have a permanent record that you are the owner of this token, for example. So you have converted an illiquid item into a much more liquid item, similar to what happens in case of securitization. So there are quite a few similarities when you look at securitization as well as tokenization. So when you look at the tokenization, is a process of converting tangible, intangible assets into blockchain tokens. That is what tokenization is. Like NFT, for example, is an actual application of tokenization concept. Digitally representing anything recently acquired, has a lot of transactions. So you want to show it digitally that you own this. So that is a token that you have on the blockchain. It can effectively, in conventional industries like real estate, artwork, etc., tokenization and securitization, they are broadly similar. So they convert the illiquid assets into liquid and tradable items, and hence they kind of resemble the process. There are certain similarities which have been outlined over here. Liquidity, both of them convert illiquid items into liquid. Diversification helps investor to diversify their portfolio as compared to pure equity, etc. Trading, they can be tradable, and this is a new financial opportunity. So blockchain as well as tokenization are two things that are slightly important when we go to the securitization concept. Portfolio management, there is some discussion regarding gold. So you can write a lot about gold on your own. So this is a physical item. So over here it is very popular. Gold is almost at a life high as we speak. The problem the gold in India largely has been held in the form of jewelry. Now the problem with jewelry is the making charges, etc., that are levied at the time of both buying and selling. So if you are a pure financial investor who you don't want to buy the jewelry and unnecessarily pay making charges, except you want to gift it to your girlfriend maybe. So if you want to look at, let us say, physical gold investment, gold bars are also used. So gold bars don't have making charges per se, but they still have the cost of storage that has to be incurred, and the risk that these gold bars can be kind of stolen, etc. So one of the ways in which gold can be invested other than jewelry is the gold bars. However, they have the risk of theft as well as storage risks, etc., are also there. Storage costs may be involved. One of the best ways in today's environment to invest in gold, also called as paper gold, is a sovereign gold bonds, which are issued by the government. Earlier there was e-gold, which was, I think, introduced by the NSE. There was also gold ETFs which were popular, wherein they were tracking the gold prices. E-gold as well as gold ETFs broadly track the gold prices, and they give you return in the form of paper. So if the gold price goes up, your paper value of that ETF actually increases, otherwise it decreases. Sovereign gold bonds, in addition to that, at least in India, have gold as the underlying, but they also give you a cool 2 or 3% interest. Now if I'm getting an interest as well, then why would I go somewhere else? Yes, if I want liquidity, I might have to go to the gold ETF, etc. But otherwise, if I'm okay investing and taking the redemption at a particular date, then sovereign gold bonds are the best, because you don't have to incur that uh, cost of storing. There's no risk. You are getting the return in the form of gold price appreciation if it happens, and to top it up, you are also getting some interest. So over here, this is a very important instrument, the sovereign gold bond. You would be aware probably. This is government security, so it is virtually risk free, issued by the RBI, backed by grams of gold. Apart from that, you are also going to get certain interest. Gold traded ETFs and e-gold. E-gold was given by the NSE. Gold traded ETFs are based on mutual funds. They give you flexibility of that of a stock investment, so you can buy, sell, etc. They track the prices of gold. So there are 4 instruments for gold for a financial investor other than jewelry. Gold bars. Then you have sovereign gold bonds, one of the most popular things. Gold ETFs and e-gold. So earlier when sovereign gold bonds were not there, gold ETFs and e-gold was also as popular. Okay, so this is regarding gold. Next, you have this security valuation and financial policy. So I think we are almost done. So when you look at financial policy and security valuation, there's only a lot of literature given regarding the role of a registered valuer. So we'll quickly flip through that. But other than that, when you look at financial policy and corporate strategy, the new thing that is added over here is the advanced role of a CFO. You will grow up to probably become a CFO. Usually the objective of a CFO, like you study in your inter CA FM, is to kind of maximize wealth. That has traditionally been the role of the CFO, which is still the role. But now the role of a CFO expands beyond that as well. So yes, wealth maximization, managing internal controls, etc. has always been the traditional forte of a CFO. Managing the financial health, managing adequate controls, these have been the traditional roles of a CFO. Apart from that, certain new roles are also put in, which is risk management. So your overall risk management framework is to be managed by the CFO. Supply chain, especially post-COVID, the supply chain management, CFO kind of is working on, let us say, financial, etc. parameters. So supply chain management system being in place is also now considered to be within the fold of a CFO. Mergers, acquisition, inorganic growth is also now to be looked at by the CFO, and certain ESG considerations. So over here you say RSME. So over here, SME can be small and medium enterprise if you want to remember it. RSME, that is R over here is risk management, S is supply chain, M over here is mergers and acquisition, and E is ESG. So an additional responsibilities of a CFO will involve having a risk management system in place, supply chain management in place, mergers and acquisition, as well as ESG frameworks. So that is about it. Next and the last part over here is on security valuation. So when you look at security valuation, there is a role and responsibility of valuers for the security valuation. When we look at the role and the responsibilities, so what are registered valuers? Their responsibility is largely for the purpose of legal regulations and compliances, maybe under FEMA, maybe under RBI, maybe under the respective laws wherever it is required. So for so much statutory or information, forget about every other things. Your index, hundreds of places where you have to get the fair values. Maybe some of them we'll have to take to the registered valuers. So over here in merger and acquisition setup, for the purpose of tax laws, you might need this. For slum sale, under the insolvency and bankruptcy code, you might need this. Conversion of debt security for RBI might need it for foreign investment. Capital reduction, if you are doing as per SEBI guidelines, you might need it. Strategic financial restructuring, you might need it. Other than that, for index purposes or court orders, you might need it. So these are the various places where a registered valuer, remember, stock broker per se who gives a valuation recommendation is not a registered valuer. A registered valuer is a valuer who is a category 1 or 2 or 3, maybe merchant banker or some other valuers who clear particular exams, whose valuation can be used for the purpose of legal and statutory purposes. A regular stock broker is not a registered valuer. A lot of your CA firms or lawyers, etc., can be possible registered valuers. So don't think of a stock broker who gives a buy target as a registered valuer. No, these are valuations to be done as per statutory requirements. So over here, the responsibility of a registered valuer, you will see a lot of theory. It is similar to ethics that you have in case of your professional ethics. So general gyan, you would say, is integrity and fairness. You should be honest, you should be straightforward, you should not try to manipulate or do window dressing. Being honest and straightforward, provide true and adequate information. Professional competence, you should try to ensure that you have the skill and the competence, you are updated with the things, and you are having the expertise. Maintain professional knowledge, should not disclaim liability. You should not say that I am not responsible for this valuation. You should be able to claim the responsibility for the report that you have given. Independence is a very important thing. So first thing is you should be honest, fair, integrity tops everything else. You should be competent enough, you should have professional competence, and you should be independent. You should not be related, you should not have any assignment, and if you do, you should have been given a disclosure. You should not be holding stocks after you are a part of this assignment. So there is objectivity, which is a must. That is independence. You or your relatives should not be related, and if they are, adequate disclosures, etc. should be given. You should disclose to your clients possible sources of conflicts if you have. You should not deal in securities. You should not engage in mandate snatching. What does mandate snatching mean? Quoting any low price just to get the deal, or convenience valuation, promising that I'll give you valuation you want if you give me kind of. So you should not be doing that. That affects your independence. You should not charge success fee, because valuation is irrespective of your success. It is a fair evaluation, not only if you are successful, otherwise you are not independent. You would want to give a valuation in such a way that the deal goes through. You should declare past association with the company, if any. Confidentiality, you should not divulge the information of your clients to someone else. You should keep it confidentially with you. So basically, first is the responsibilities: have integrity and fairness, professional competence, independent and objective, confidentiality to be maintained, and information management. You should have proper records to maintain written records, standard operating procedures. You should assist maybe the regulators in case there is an inspection or an inquiry with all the data. You should keep the records at least for 3 years, as what is prescribed over here. Respect the confidentiality of information. Have proper working papers for at least 3 years for production before a regulatory authority for peer review. In the event of a pending case before a tribunal or appeal, you should maintain all the necessary information. Gifts and hospitality. You should not accept gifts or you should not even offer gifts to people which can affect your independent thing. Remuneration and cost should be transparent, should not accept charges other than those that are disclosed, and you should not be in full-time employment, etc. You should not engage in so many assignments that you're not able to track, etc. There are close to 30 points. At max, you're going to be asked a 4-mark question. I don't think that there is so much thing. Even if you remember these main headings: integrity, professional competence, independence, disclosure of interest, confidentiality, management of information, gifts and hospitality, remuneration, occupation and restrictions, that should be sufficient. And then you have precautions needed to be taken by a valuer before accepting any valuation assignment. So the precautions that you should be taking over here is: a good valuation does not, it's not just number crunching. You have to understand also the narrative. It does not necessarily need to be an precise estimate of value. Valuing a company is much more than just evaluating financial statements. You should also look at the underlying story, etc. More often than not, investors tend to focus either on numbers or story without attempting to reach a middle ground. You should try to have that ability. And also behavioral finance. When you kind of look at a valuation report that is based on numbers, but you should also have other things like you should not. There is behavioral finance. You see a lot of deals also on Shark Tank which happen because of emotion. So this is not based on a particular valuation report. So these behavioral factors are also equally or as important. Okay. So I think that should be it. In the addendum, you have a few questions from the RTP of May 24 as well as November 24. You can refer the theory questions over there. Most of the theory questions over there are from this new section added or the existing section which was already there. There is no new thing per se over there, though we have as a part of this also shared an addendum involving these questions. If you go to see, these are broadly similar questions. There's also a new chapter on capital budgeting. So for that we don't have a separate theory per se from the past compilers. So for that you can just go through the theory. You see the institute material, at the end they have asked you 4 or 5 theoretical questions on explain about certainty equivalent, what is sensitivity analysis, what is scenario analysis, what is simulation analysis, theory questions. So maybe refer that for capital budgeting theory, because that is not a part of your compendium or your entire theory compiler, because what we have done in our compiler, which you might have referred, is we have compiled from the past questions, RTPs, etc. Capital budgeting is relatively new, though the theory question in the study material for the capital budgeting has been fairly direct. So ensure that you spend some time in the capital budgeting theory as well. You might there might be a question that might land up, but the question it is in the study material of the institute, if you go to see, are direct questions. So if you see, just a second, I'll just run you through so that you are aware. So over here you have this compendium where you see from RTP the questions over here. You can just quickly review. We have also added a few institute study material questions additionally. An exam questions of November 23, which is mostly based on the theory that you have done. What is Vega, what is rho in option value. You can just read through it. If you have any questions or problems, you can just but there's nothing new per se which has come. Like you have unicorn, features of a startup should be referred to as unicorn. Okay, a couple of November 23 interesting questions are there. So if you want to discuss that, we can possibly discuss that. See, succession planning for RTP, this we have already done. So that's done over here in November 23. If you go to see, there's this question where there is a startup. This is again I'm just running through rather than discussing. I'll spend 5-10 minutes and finish that altogether. So Nia Healthcare is a proprietary concern which is engaged in manufacture and development of pharmaceutical products in the last 5 years. Okay, so it is operating since 5 years. To scale up its operations and present turnover, which is around 500 million, that is around 50 crores. Proprietor decides, kya baat hai, proprietor is 50 crore turnover, to convert the existing business into a private limited. He also wants to get access to various tax benefits under the Startup India initiative. But this is getting converted. Remember, for Startup India, you should have been set up in the last 10 years. Turnover should not have crossed 100 crores. You should be having new ideas, technologies, leveraging technology, all that is there. But one of the things is you should not be formed out of conversion. Here, you are being converted, and as a result, provided the entity is not formed by splitting up or restructuring, this will not be considered as a startup. So Nia Healthcare, if it is forming a new company, this is on conversion. This is not going to be treated as a startup. So in view of the above, it cannot be recognized as a startup, even if it is less than 10 years, turnover is less than 100 crores, as the case may be. Second, in November 23, we have another question. In deal structuring, many structures facilitate the exit. Venture capital may put a tag-along clause. What do you mean by tag-along clause? Tag-along clause quite literally means that if the promoter is exiting, then the venture capital fund will tag along. So they will exit together. It is not that you can leave the venture capital fund. What do you mean by that clause? Explain deal structuring and the exit plan for the venture capital process. So basically, deal structuring is how do you structure the deal in such a way that there's a win-win for both the buyer and the seller. I think the answer over here is printed for something else. You can refer the actual answer from the institute material of November 23. Conversion factor in case of interest rate futures. We have put a separate question for a conversion factor which has come in your interest rate future November 23 papers, the binomial as well as the interest rate future. Conversion factor is the number of bonds which equivalent bonds which are used to settle, for example, a notional bond in the interest rate future. So there may be a notional bond on the interest rate future, and to settle that bond for giving delivery, you might end up, let us say, giving some other bond. So vis-a-vis the notional bond, what is the conversion factor for this bond? Depending, a superior bond will have a higher conversion factor, will have a higher value. An inferior bond will have a lower factor. So that is conversion bond in features in case of an interest rate future. Unicorn is already discussed. So you see, most of the MTP RTP questions are from the new material over here. Define Greeks. Greeks are like option, delta, gamma, vega, rho. They try to measure the sensitivity of your option in response to a particular factor. Like delta is in response to price, gamma is in response to, let us say, the delta movement, vega is in response to volatility, rho is in response to interest rate, theta is in respect of time. in the study material, stock index futures are becoming more popular over stock futures because there is a lot more liquidity. It is much more diversified. It is much more cost efficient. A lot of theory points are given over here. It is very difficult to manipulate stock index futures on a single stock, and hence the promoter might manipulate index futures. That is not possible. So there are a few things that you can refer. While securitization of securities is backed by SPV, are backed by loans, CDOs are backed by pools of bonds, REITs, etc. Describe the main types of risk associated with CDO. Over here we have discussed those risks, that same risk as that of bond: default risk, interest rate risk, prepayment risk, reinvestment risk, etc. This is also, I think, done along with CDO. Vega is volatility, rho is rate of interest. Advantages of mutual fund: it is a general theory which has been added. So what are the advantages? Professional management, diversification, lower cost, best professional expert, etc. Tokenization के ऊपर एक question resembles securitization. The similarities between tokenization and securitization: both of them convert liquid assets to liquid items. They provide liquidity, etc. Diversification, trading opportunities. What is a zero coupon bond? You should be easily able to answer that, which is giving zero coupon but is issued at a discount. Usually helps in long term planning. Duration of a coupon bond is always going to be less than the time to maturity, because the way duration formula is, even if it is a zero coupon bond, the duration will be equal to maturity. It cannot be greater than the maturity. Okay, there is one additional thing over here about efficient market theory. Efficient market hypothesis given by Eugene Fama, and Eugene Fama assumes that the price, in case of the strong form of efficient market hypothesis, it covers everything. So it is impossible for you to make a return. However, that is not always correct, because markets are inefficient. Sometimes there is semi-strong form, there is weak form, or the markets may be inefficient per se. So this is regarding weak form efficient market hypothesis. The misconception that they carry is that you just cannot make a return because market is efficient. However, the movements in markets have been random, and it is impossible to predict the future. Who would have predicted COVID-19 in 2019 with the best of the financial models? It was impossible, and hence to say that you cannot earn returns beyond the average is not necessarily correct. Okay, in the current scenario, the role of CFOs have been drastically expanded, like we studied risk management, supply chain, mergers, environmental and social impact, etc. Okay, so this is regarding the new parts which were there in the RTP, MTP, or even the exam questions. Briefly, we have discussed that. I hope this has been helpful. This kind of takes care of everything. In capital budgeting also, if we see, I've tried to compile from the study material. All of this is ICAI SM. In ICAI SM, you have 4 questions in the theoretical section from advanced capital budgeting, and I've taken exactly that. First is write a note on certainty equivalent. Well, in certainty equivalent, if you have done the sums, you have the cash flows, the expected cash flows, and you multiply it by the certainty equivalent. That will give you the certain cash flows, which you discounted the risk-free rate to find, let us say, the risk assessment for the project. That is certainty equivalent. Then is sensitivity analysis, where you keep one factor, you change one factor, keeping all else constant. That is your sensitivity analysis. Can be done in various ways as well. So that is regarding sensitivity, some theory mentioned. This is from the study material directly. Project appraisal under inflationary conditions. If there is inflation, your cash flows will change because of inflation. Your discount rate will change because of inflation. Inflation should be considered. Exchange rates will also be having an impact due to inflation. So your project evaluation under inflation conditions should be considered accordingly. And simulation analysis, there is something called as a Monte Carlo simulation, where you will assign random numbers and then try to run loops, simulations, find different cash flows using that random numbers, and then try to find various NPVs. And basically your final NPV will be based on the sum total of the hundreds and probably thousands of simulations that you might have run. So this is regarding some bit of capital budgeting, but it is best if you kind of refer the institute study material as well. So I'll share whatever is the relevant thing, especially these practical illustrations. I hope this has been helpful, and if there is some mistake, apologize to you for that, but this is based on your practical questions, which will help you in probably a better understanding. So I hope this video has been helpful to you. If yes, please do like, share and subscribe, and I'll see you soon with some other important, useful content. Till then, goodbye, good luck and study well. Have a good day. Bye-bye.